Today, it is my great pleasure to be speaking with Greg Kaplan and Michael Brennan here at E61 Sydney office. Greg is one of the smartest macro economists in the world. He's the co-author of one of my favorite papers on the US housing bubble. He's a professor at Chicago, but he spends part of his time back in Sydney where he's a co-founder at E61. E61 is a non-partisan, independent economic research institute. I'm also joined by Michael Brennan. Michael is one of the most knowledgeable economists I've met. He's the CEO at E61, but he has deep public policy experience. Prior to his role at E61, he was chair of Australia's Productivity Commission, which is a very cool institution, which is essentially like a think tank for the Australian government, which does deep economic research. And before that, Michael was a deputy secretary in the federal Treasury. He's also worked in the state Treasury in Victoria and been a senior advisor to treasurers and finance ministers at both the state and federal levels. So guys, welcome to the podcast.
Thanks for having us.
Great to be here. Thanks, Joe.
Basically, what's going to happen is for the next couple of hours, I'm going to pepper Greg and Michael with all of my untutored questions, and they're going to teach me a few things about economic and productivity growth and how to get more of them in Australia. Obviously, we are three patriotic Australians, but this conversation, I think, will still have interest for our international audience in two ways. Firstly, we'll be talking about productivity more broadly as sort of an economic object. And secondly, people might just generally be interested to hear how a smaller country of about 27 million people like Australia thinks about how to get more productivity growth, because obviously this is a problem across the West. I actually want to pick up where we left off when we caught up a couple of weeks ago. So the three of us were chatting and you two were riffing on construction productivity and why it's stagnated. It's interesting that it's stagnated not just in Australia, but also in the West more broadly. I'll put these charts up on the video version of this episode for people watching on YouTube, Twitter and Substack. But here we've got Australia's housing construction productivity decline. This is labour productivity. So this is a report the Productivity Commission published several months ago. And we also have a chart for advanced economies, so we can see clearly this is a problem around the Anglosphere. And when we were catching up, you guys were sketching out a theoretical argument tied to fixed inputs and the durable nature of housing. And I don't think I'd heard that argument before, but could you just recap that idea, and then have you taken that any further since we last caught up?
So I'll have a first shot. Thanks, Joe.
Yep.
I mean, this theory, maybe wild conjecture. Yep. I don't know. We'll listeners can be the judge. But one of the starting point for this was thinking about this paradox, if you like. Why is it that we are so much better and we're getting so much better over time at building things in factories, but no better at building things out in a field, in a paddock, or in a dense urban environment? And there may be a whole range of reasons for that, and obviously there's been a lot of speculation about the ways that we could make construction more like manufacturing and bring elements of the process into the factory through modular housing, et cetera. But one of the things we were thinking about was, is construction fundamentally different in this respect, that in every other industry, say manufacturing, the annual production each year kind of gets repeated. So the most efficient producers of any given good are producing again next year and the following year and the following year. And to the extent that the product is growing, there's an incremental bit that maybe is built by a factory that's less conducive to high productivity. But those, what we describe as economists, those inframarginal units are getting repeated every year. Construction's fundamentally different because in construction you're not repeating those inframarginal units. You know, if in the construction sector you've already built housing in the most propitious, easy to build areas, those most conducive to a high productivity build, you can't come along and reproduce that next year. That's not going to be factored into the production statistics. You're going to be building on successively, one would expect, harder and harder in harder and harder places. Now, that's an empirical claim. It may or may not be true. It might be that, particularly with greenfields housing, it really doesn't matter. You can just move further out in concentric circles from the city and it's just as easy. Maybe that's true, but it just struck us as something that might be a little bit distinct about construction, that sense that you don't get to repeat the easy units each year. And therefore, it could be just a little bit harder for measured productivity in the construction sector to continue to rise year on year the way we expected it might in others.
Yeah. So to make sure I understand, there's this observation that, okay, you don't have like these economies of scale in construction, like you might in, say, car manufacturing, where every model's the same, because in construction, most houses or most units are bespoke in some sense. But I feel like you're taking this further to show, well, actually the units like quickly get quite different or a lot more bespoke, and then that sort of bakes in the productivity slowdown. Is that the idea?
Yeah, well, also that in cars, if the most efficient factory is in Detroit, it's, or wherever it is, right, it's producing those high productivity amounts of output year after year.
Yeah.
In construction, you might have used up the most high productivity sites if you think that sites might be conducive to a more efficient build, say. You've sort of exhausted them because you're now the distinction with construction, I guess, is it's an increment to the stock. Okay. That's what you're doing each year.
Yeah.
You don't get to revisit the stock and reproduce that each year. So the inframarginal units don't get repeated in the same way.
Yeah.
Yeah, there's sort of two features of housing construction which are a little bit different than the car. One is the durability of the good. It's extremely durable, a building relative to a car. And the other one is the reproducibility of the factor that goes into that, which is land, which is extremely irreproducible. But then also the even improved land, you have to think about critical infrastructure. So it is a little bit more of a continuum. But and there is a role for government there, because part of what makes it reproducible is whether or not you invest in what that infrastructure is to make a new set of greenfield usable. But that difference means that you don't get to reproduce those inframarginal ones as often. And when you do, you're kind of going down a upper marginal cost curve, down a supply curve as you do it.
Yeah. So do you have like a hunch for empirically how important this might be?
Well, it's hard to know. I mean, we've got, in fact, one of our researchers here at E61, Matthew Maltman's been working on a paper in relation to productivity growth in the construction sector in New Zealand at the point exploiting the natural experiment of when planning laws were substantially liberalised. And the result appears to be that you do see an uptick in measured construction productivity post a liberalisation like that, but it does fade again over time. And this is not a robust empirical test, but that set of facts would be consistent with this sort of theory, I guess, that there's an initial kind of almost gold rush around, here's a new opportunity, the best and easiest and most productive or economically viable builds will be done first, and thereby, you see a bit of a rise in construction productivity, but it will probably abate over time as those the best sites or the best prospects are basically done, and you're moving on to the next lot. I'd have to check what the kind of percentage improvement in productivity in that instance was, but it was a noticeable uptick.
Okay, so here's a thought experiment. Think of all the different levers we have to get construction productivity growing again. There are the classic planning regulations, the kind of things that YIMBYs are concerned with, like what Matt was looking at. There are also, I guess, like regulations that apply to maybe the labour side of the construction industry, things like union rules, enterprise bargaining agreements, building codes, all of those types of regulations. There are things like worker quality, things like, I guess the structure and fragmentation of the industry, how well it innovates, maybe tax incentives that cause it to be so fragmented, because it is a super fragmented industry. I think I'm trying to remember the CEDA report that came out recently, but I think in their report, it's like 98.5% of Australian construction firms are 20 employees or fewer. It's just like a super fragmented industry, and it's the larger firms that are more productive. So I think firms of like 200 or more employees made 86% more revenue per employee than the firms of like 5 to 19 people. Okay, so there are all these like different levers to get construction productivity moving. Now, as a thought experiment, hold the planning regulations constant. So you can't advance the YIMBY agenda. You can just pull on these other levers. If you could pull on those other levers to get construction productivity moving, how much do you think that would move the needle on housing supply? Or is housing supply basically stuck unless you first address planning regulations?
So I don't have a neat answer about the relative proportions, but it is clearly a bit of both. And just to think about it in terms of a basic supply and demand diagram, if at the margin the supply curve is vertical, which is to say the planning restrictions bind, you are just prohibited from building that extra unit, then theory would suggest it really doesn't matter how efficient the construction sector gets. All of that will just flow in additional rent to the supplier. It's not going to increase quantity, right? It's not going to increase volume. And I suspect that is the situation that confronts us in certain areas. So where there are restrictions on density in quite high value areas, the supply curve is essentially close to vertical. So construction productivity is not going to be a thing that really moves the needle there. There are no doubt other areas, because you do hear feedback from the construction sector about, it's just not economical for us to build in particular areas, i.e. the cost of the product, the price of the product that we would be building just won't sell. There's not a market for it. And that suggests, and maybe this is more in greenfields areas or more in some density, but in some lower value land areas, that the supply curve there is upward sloping, and there you would expect that if you can reduce the supply curve, move it downwards or to the right, reduce cost, there will be an increase in supply. And so I think that probably is the situation that confronts us in certain markets. So I think it is a bit of both. I guess the only thing I'd say about, the difference in quantum around that is that productivity in a sector like construction or any sector, if you're getting positive productivity growth, it's going to tend to be pretty incremental year on year. It might be 1.5%, 2%, maybe it gets a bit more rapid if you get a big technological breakthrough. But it's going to be sort of hard grind and incremental over time. Relaxing supply constraints could operate more quickly if you're prepared to do it. And so I think in the near term, it's likely that the supply constraints probably would have a more appreciable effect if you're prepared to relax them than the various channels of productivity growth that you mentioned.
Interesting. Okay, so imagine we get rid of all of the planning regulations that, say, Peter Julep wants to get rid of. Imagine that we also get labour productivity in construction moving back to some kind of reasonable growth rate. What would the new constraint on more housing supply be? I feel like at that point it becomes more of a sort of political constraint, because if prices fall too much too quickly, people lose a lot of equity, and then you maybe even risk a balance sheet recession. Is that at that margin, is that the new constraint on more supply?
I don't know. I mean, so the thought experiment is that we've got productivity growth more broadly up. That's the idea. So, or you just mean in the construction sector?
Let's say just in the construction sector. Yeah. And it's like a YIMBY utopia. So we can build wherever we like. So supply can accumulate, I guess, much more rapidly than it does today. Is then it like a sort of political economy problem where we don't want to bring prices down by too much too quickly?
Well, I guess there would be vested interests for that for sure. Because right now, if the supply curve is vertical, as Michael is conjecturing, which I think is right in certain areas, that suggests that there's rents to be had if you can expand that. And those rents are going to accrue to the people who are currently, the builders who are going to build there. The people who are going to lose are the people who are currently accruing those rents, which are the current owners. So in that situation, you would think that the constraint is going to be what are the vested interests of that group and what is their political ability to wield that. But again, that's only one part. I think it's only one part of the country when we think about those very high density areas that we'd like to make even more high density. I think it'd have less of an implication on smaller cities more generally than that.
It is an interesting thought experiment. I mean, when you think about what drives opposition at the moment to density, the argument that it's going to undermine property values doesn't crop up a lot. I wouldn't have thought. It tends to be about amenity and character, neighbourhood character, shadowing, some traffic, the sort of urban amenity issues. But that's partly because we haven't had a lot of success. So I think in the world that you imagine, it's not impossible that you would start to get a bit of more explicit opposition. I mean, sometimes the opposition maybe would be a bit tacit and, not kind of revealing the true motive. But even honest opposition around this is going to kill our property values. We don't hear that a lot, but it's not impossible you could hear that. Yeah. In a way. And it would, to Greg's point, it does represent a transfer from incumbent property owners to would-be entrants, I guess, because part of making housing more affordable for entry is that the price comes down.
Yeah.
Yeah, I mean, I feel like there's a long way to go in the sense that prices in the areas we're talking about have got up by a lot. Right? It's not clear that we're talking now about falls in prices, which is sort of the balance sheet issues you're concerned. Maybe it's slowing the growth in prices. And there's a lot of scope before you think you could make a compelling argument that there are stability concerns or macroprudential concerns of a big drop in housing prices.
Right. As a shorthand, let's call the concerns about loss of home equity the home voter hypothesis. And the other stuff is like amenity concerns. That's I don't want noisy, ugly construction in my neighborhood. Tell me if you think this is incorrect. I feel like the second set of concerns is currently what characterizes most NIMBYs in reality. The first set is like the mental model that federal politicians have of the average homeowner.
That could be right. I think at the state level and the local level, they've probably got the NIMBY mindset a little more in mind.
Yep.
It's the controversy over densification and people's cherished neighbourhood character changing.
Yeah.
But yes, you could be right.
Yeah.
That could be the sort of I think there is an element of at the federal level a bit of a tradition of and former prime ministers and senior ministers have made that observation. Nobody ever complains to me that their house is worth too much.
Yeah. Yeah. The last 2 decades of Australian housing policy at the federal level have been bookended by leaders from either major party making comments like that. There's like the famous Howard radio comment 2004, and then last year there's Claire O'Neill on Triple J. To take this thought experiment one step further, and this could be pretty difficult because we don't have like data and spreadsheets in front of us, but say labour productivity growth over the past decade and a half was, instead of the pretty lousy, 1% or whatever it's been, was actually something closer to the sort of, in the market sector at least, closer to the 2% we had just after the reform era. So this is like late 90s, early 2000s. How much more politically palatable would house price falls be if we'd had that stronger labour productivity growth? So presumably, people have higher incomes, people are richer. Does then that make them more willing to accept losses in home equity?
Yeah, I'm pretty skeptical that it would change much.
Okay.
And so,
why is that?
I mean, let me lay out a couple of things. One is that let's go with your counterfactual. We had twice as fast productivity growth over the last 10 years. Mm-hmm. There's no guarantee about where those productivity growth is going to accrue. So, productivity growth is a very aggregate thing, and the distribution of how that plays out in the economy, there's many, many ways in which it could play out. And it's not necessarily obvious to me that the group that you're thinking of is going to be the biggest, are going to gain all of that. So I think we need to think a little bit about what does that productivity growth look like and how did it manifest in wage income and in household income more broadly, number one. I think the second thing is that if you look at the vested interest we were talking about earlier, for a large part, that's not a group of the population whose income sources are necessarily that sensitive to the sort of labour productivity growth you're talking about. It's a lot of passive income. There's a lot of investment in second properties, other wealth accumulation, superannuation, those sorts of asset where it's unclear that would shift so much away the reliance on home equity as a generator of wealth.
All right. So
I share that skepticism a bit. I mean, one observation is that although productivity growth has been pretty sluggish over the last 25 years, income growth has actually been pretty good by virtue of the terms of trade. So, and if you think about when, this is a totally unempirical claim, but here goes. When have Australians, when is the general mood or zeitgeist suggest that Australians have felt most prosperous? It's an interesting thing to reflect because we talk about the reform era of the 80s and 90s. My recollection living through it was much of that time people didn't feel particularly prosperous. Even the 90s with its rapid labour productivity, TFP growth, it's not as though the headlines were telling a story of, we're really going well here. I think people did acknowledge a degree of prosperity around the middle part of that first decade of the 2000s and when the terms of trade boom really took off, that sense that, the budget was in balance, there were tax cuts flowing, income seemed pretty high, the dollar was worth a lot. There was, people are perhaps always a bit grudging, but I think there was more of a sense then of, life felt pretty prosperous. And I don't think it really translated into moving the needle on this sort of debate. So I think it's tempting ex ante to say, if we could get greater prosperity, maybe there'd be a greater acceptance of some of these hard choices. I'm not sure in reality, or whether our expectations just adjust. I don't know.
Yeah.
It's also not even clear to me that faster wage growth wouldn't translate into higher house prices.
True.
Yeah, if there's a scarcity constraint.
Given the constraints we're talking about.
Yeah. Okay, so one final housing question. Do you both buy the standard YIMBY argument that densifying our major cities, particularly Sydney and Melbourne, would lead to big gains in productivity?
So I don't. I can't talk for Michael. I think that there are cities which would benefit from densification. I'm skeptical about the Sydney-Melbourne argument. So what's the number? Like 40%?
About 40% of Australia's population is in Sydney and Melbourne.
Yeah, it's hard for me to see where those productivity gains would come from. So when I think about the spatial productivity, I think about competing forces between agglomeration on one hand, which I think what you're getting at, the YIMBY movement's getting at, versus congestion on the other hand. And
what do you mean by congestion?
Yeah, so congestion in economic terms, it's sort of the negative of agglomeration. The way economists would model this is they just stick a minus sign in front of that. But it's capturing the idea that when you have, what's agglomeration? It's that we put more people in the same place, and as a result of the number of people, each individual person is more productive, able to produce more. Congestion is going to be more people makes it harder for any one individual person to produce.
Okay. So can we just, before we move on, can we just unpack the channels by which that those gains of agglomeration work? So there's better matching in the labour market, but are we also including things like knowledge spillovers in this? Okay. The existence of cities like New York and London and San Francisco and like the enormous knowledge spillovers there, don't the existence of those cities just like automatically refute the claim that we're not going to get net gains of agglomeration from densifying Sydney and Melbourne?
I don't think so. Firstly, it's not obvious to me that the relative size of London relative to the rest of the UK is a net benefit for the UK. Might be good for London. I'm not sure that it's necessarily good for the UK. So I think we need to think about, even in this discussion, when we talk about what we're trying to do, are we trying to improve the welfare of Australians or the welfare of people living in Sydney and Melbourne? So let's put that aside. Second thing would be that, yes, Sydney has very strong geographic constraints, which are real. Okay, so it's not immediate. Now Melbourne less so. Michael knows more about this than me, but so I think that it's not obvious to me necessarily that it's feasible in a practical way. But those agglomerations, you mentioned two, right? You mentioned that firms and workers can better match to each other, and the other one being that there's some development, some new ideas happen somewhere. It's easier for them to be spilled over, used. You work with firms in the same sort of same type of industries. I mean, I think there's another one at a more social level, which is where do people want to locate? Where do they want to set up their their lives and make plans for the future. And that requires things beyond just jobs. It requires infrastructure, healthcare systems. It requires good schools. It requires social networks and a broad different groups of people that people can form community with and connections with. And that comes from reaching a critical size. Now, those benefits from agglomeration are going to exist at different scales than some of the other benefits. So you could tell a story, and I don't know what these numbers are, I'm going to make them up, but there's something very different between living in a city with 2,000 people and a city with 200,000 people along the sorts of dimensions I just mentioned that are different between going from 200 to 2 million or 2 million to 20 million.
Right.
So I think that when I talk about the difference between the potential gains come from increasing supply in, say, Sydney and Melbourne versus other parts of Australia, I'm thinking about the difference between the gain in going from a 5 million person city to a 10 million person city versus growing some of the cities in Australia that are a couple of 100,000 people to a couple of million people. And so some of what I'm saying is a statement about where those potential agglomeration gains will come from. And then some of it's also this congestion, which we haven't talked about, but the congestion force that's working in the opposite direction.
Okay. So Yimby Greg would focus more on densifying places like Canberra.
I think that's a great idea.
Yeah. Is there anything more you want to say on the congestion?
I think just that a lot of people forget about the congestion. I think that's there are some, you're right, you mentioned New York and London, these are really big cities. But there's some really difficult things about living in New York. I've lived in both of those cities. I'm very happy that I live in Chicago now and not in New York or London in terms of where I am in my life with young kids and a family. I also know that there's very other big cities of the same sort of size in the world that are not as productive anywhere near as New York and London. And I think we can talk about some very large cities in Asia where people will tell you that it's the congestion that makes it very difficult when you don't have the right transport infrastructure and other types of infrastructures to be able to realize those agglomeration gains. So it's just not an obvious thing to me that, yes, we just need to make Sydney and Melbourne bigger because they're currently more productive, therefore put more resources there.
Okay.
Yeah, I share a bit of the skepticism. I think up front, it feels to me the productivity argument is a bit secondary to the housing affordability argument.
Which is more of a welfare thing, right?
Yeah, I think that's right. The strongest Yimby argument for densification is that it will reduce the cost of housing or make housing more accessible and more affordable. Is there a productivity gain there? Potentially. I think one of the interesting questions, and I'm kind of pondering both New York and London now in my mind, but I think Greg's right that sometimes these agglomeration benefits operate or may well operate over slightly different scales. So I think you're right to kind of separate out because conceptually they are a bit distinct. The matching benefit, which is about if I can get a bunch of employers and a bunch of employees together in the same location, and they spontaneously have pretty good incentives to do this, right? If a firm is located within a, I don't know, call it a 40-minute commute of, for 2 million workers or 5 million workers or whatever, it allows them to pick a very specialised worker for a niche role and vice versa for the worker. That's the matching benefit. The knowledge spillover is something kind of more mysterious. It's this idea that there's ideas that just transmit by virtue often of physical proximity and interaction. My gut is that the matching benefit can operate over a scale of a kind of urban area. The knowledge spillover feels like it's something that operates over a much smaller geographic scale. It's about a cluster of workers and firms within a smaller area. And this is, most of these precincts that emerge spontaneously, or sometimes government tries to create them, they're often motivated by that kind of, much smaller scale agglomeration. So, yeah, I think it's an interesting question at what scale you get, because you might be able to devise transport solutions and a degree of density in these cities such that you better link a whole lot of people to firms and jobs and get the matching benefit, even if we're not in all cases dense enough to get some of those knowledge spillover benefits.
Yeah. Okay. I've started this off by taking us sort of all the way down the construction, housing, urban economics rabbit hole.
Yeah.
But I actually just want to take a step back now and talk about growth and productivity more broadly. But we'll do that first by looking at some measurement issues and some of the metrics that we might want to be optimizing for here.
Okay.
So, Greg, some of these questions might be more in your wheelhouse, but Michael, obviously feel free to jump in at any point. So we'll start with the metrics and measurement issues. Firstly, GDP. Greg, could you outline what you think are the most important limitations of GDP as a metric? There are many, but which are the ones that give you most pause?
Okay, I'm going to give you the economist answer. It depends. Yeah. And if you'll let me maybe take a step even further back.
Yep.
I naturally want to ask a metric for what, right? So I think there's a big question of what is it we're trying to do? What is it that we're trying to measure? Why are we measuring GDP?
Yeah.
Right? So GDP was not invented as a metric to measure welfare. It was invented as a metric to measure how much stuff we produce. Right? Now that turns out to be pretty well correlated with welfare, and there's a reason why then we tend to look at it, which I'll go into. But I think let me make 2 points from the outset. One is that ultimately, if what we're interested in is in welfare, that is a distributional issue. There's a lot of different people. There's There's a lot of different things that those people are doing. So there's you and me, and then there's stuff I consume, there's goods I buy, there's time that I spend, there's my physical and mental health, there's all sorts of aspects of me. And so we need to somehow aggregate both across the things that contribute to my welfare and then across people. And then there's sort of how, which is how do we then do that aggregation? And so there is no going to be one right answer to that question from the outset. Let me make the case for GDP, because I think before we talk about the limitations, I think it's important to be clear about what it does well. I think it does two things really well. First thing it does is that it's well-defined and we can measure it. So if we want a metric, those are two features that you think are
pretty good.
Pretty good, right? So it's easy to come up with hypothetical things you might want to do, but we want to be able to compare across countries, across time in a consistent way. And we need to be actually able to do that. We need to be able to measure it. So GDP ticks that box. Second thing is that it turns out that it's very highly correlated, both across time and across countries, with all of the other things that go into our welfare. Now, that's a statement about correlation. It's not a statement about causation. But it is a way to see what's going on. It's pretty hard to find examples. And of course, we can cherry pick some where GDP doesn't grow, but welfare does, vice versa, over long periods of times or across very broad, big differences across countries. What are the limitations? So I think there's the biggest ones for thinking about this as welfare are, the first is that GDP, okay, what is it? It's trying to measure how much stuff is produced in a particular place over a period of time. First thing is that we produce a lot of stuff, and GDP counts a whole bunch of things that may or may not be relevant for our welfare. So we're trying to aggregate, and so how do we do it? We do it using market prices. We use $1 of this and $1 of that. We add them up. It's $2 of stuff. But whether that's $1 spent on weapons or $1 spent on pastries is completely irrelevant from the point of view of GDP. And so when thinking about welfare over large periods of time or across, looking at fluctuations in GDP or across different countries, I think that's a big issue. The second thing is that I think the distribution issue. So fundamentally, GDP is an aggregate, and it doesn't necessarily tell you anything about the way in which that those resources are distributed across people. And then finally, of course, we've mentioned that it only measures stuff that you can attach a market price to, because we have to add things up add different types of goods up. So it's going to leave out things like health, mental health, environment, and all the standard things that you can read about in a textbook.
Yeah. Okay, great. So next, is there just like a growth accounting in 2 minutes for economists?
I can try.
Yeah, okay, let's try it. Let's see what happens.
So here's one way of thinking about the stuff that we produce. GDP is how much stuff we produce.
Yeah.
We produce stuff by combining capital, which is things that are reproducible. So factories, maybe land to some extent, and labor, people. It's a very sort of, I would call it Victorian England approach to production, industrial revolution. And in fact, that's sort of the limitation. But that's the way, if you want to understand growth accounting, think about like, we build a factory, we hire some workers, they come to work at the factory and widgets pop out the other side.
Yeah.
And what we want to understand is, why is it that over time we produce more widgets? People call that growth accounting. And why is it that some places produce more widgets than other places? Some people call that development accounting.
Mm-hmm.
Now, there's only 3 reasons why one place could produce more than another place. They either have more factories, call that capital. They either have more people showing up at those factories, we'll call that labor, or they're able, for the same amount of people going to the same factories for the same amount of time, actually to produce more widgets. And this is that thing that we call productivity. So technically, that's what productivity is. It's how much stuff can you produce with the inputs that you put in, inputs being capital and labor. Now, growth accounting tries to ask over time, how much of the fact that we produce more stuff comes from the fact that we put more capital in, I mean, we had more factories, we had more workers, and that we just got better at using them. And so starting in the late 1950s, people started collecting the data to be able to do that, starting with a paper by Bob Solow. And the classic finding has been that capital accumulation plays some role, but in fact, surprisingly, a very large amount of the growth that we saw in the United States over the 20th century and across countries in the world has to do not with the amount of capital, but how they use that capital, productivity.
Mm-hmm. So when we were chatting on the phone on Friday, you mentioned that what we think of as capital in the 21st century can blur the distinction a little bit between capital, or K, in our production function, and then A, which is what we think of as total factor productivity. Is there anything worth putting on the table there?
Yeah, I think it's just good to remember that the world doesn't look like that Victorian English factory.
Yeah.
And that there's a lot of other inputs that go into producing things today. Yeah. And so I think the big thing there is that there actually are many other forms of capital than just factories.
Yeah.
So the classic one that was that people figured out very soon after we started doing these sorts of calculations was that some capital is actually embodied in people. We call that human capital, right? And found out that if you actually adjust some of those estimates for how the differences across countries, not just in how many workers, but how much capital is embodied in them by virtue of education, it accounts for a big chunk of those differences. Where I think that's playing out today is in what I'll call forms of intangible capital. So these are things like institutional know-how, organizational capital, be things like IT infrastructure and software, which are not, those are things that last over time, but are not things that are captured in the traditional sort of factory approach to what capital is. And even things today like data or models or algorithms that are a form of capital that we have, we can reuse them and they help us to produce. And so my understanding is if you kind of try it, and these things are difficult now to adjust for because how do you measure them? They don't have market prices that are very easily attached to them, but people have tried. And it's something like, if you look at the last 30 years of US growth, and I think it's probably something similar for Australia as well, that if you take conventional capital, roughly half of that growth came from 50% came from what we call capital deepening. So we just more capital, and 50% came from we can just use that capital more effectively, productivity. Once you incorporate these broader forms of intangible, more modern forms of capital, it's something more like 2/3, 1/3.
Oh, so 2/3 capital deepening.
2/3 capital deepening, 1/3 productivity. And at some level, this is just semantics. And I think this is maybe over this conversation, something we should keep in mind, that if you have a factory that has a bunch of better data in the machines inside and a bunch of better software, and as a result, you can produce more stuff, is that because you've got more, and that capital was more expensive now to build that factory versus the old one. So, there was some investment in that. Do we want to say that we produce more stuff because we put more inputs in or because we can use those inputs better?
Yeah.
It's sort of, two sides of the same coin, because a lot of those ideas, what we call productivity, is actually embodied in the capital we use. And so what that calculation I described is picking up is that maybe some of the growth that we've seen, it's not like this magic mystery. Economists call it A or Z sticking out the front of their production function. It's something that's embodied in the inputs that we use. And in order to realize that, we're going to have to invest in those productivity embodied inputs like intangible capital.
Yeah. And just to inject my own commentary here, because I've been sort of reading up on this or brushing up on this over the last few days and relearning a few concepts, but I think it's important to clarify that A, or total factor productivity, isn't equivalent to technology, although I think many times people talk about it as if it is. And a good intuition pump, or something I found helpful for getting this point, is just to notice that across some industries or some countries, TFP can have negative growth from time to time. If TFP was just technology, that would mean that those industries were suffering some kind of like technical regress. But that's not plausible, as one economist, I can't remember who put it, like we don't forget blueprints. So there must be something else to TFP, which is, I guess, efficiency or whatever you want to call it, know-how, tacit knowledge.
I mean, this is just a fantastic point. And I think it's indicative of a much broader issue that, again, we should have in mind when having all of these discussions.
Yeah.
Is that on the one hand, we've got measurement.
Yeah.
There's things that we're trying to measure. We collect data, we get numbers, and we try and compute some things. And that's the thing, that's these numbers that we compare, that's what those are. Then we have economists use models. Models are simplified versions of the world that have very clear and well-defined constructs in them. And then we try and map our world onto that simple model. So the model, I've been going back and forth between the two, even in this discussion, but the simplest kind of economic model, this Victorian England one, says that output, we call it Y, is equal to A, we call that productivity or technology, multiplied by some capital, some K, and some labor L. And in that world, technology and productivity are the same thing because it's a pretty simple world. That's all there is there. But of course, that no one thinks that's what the real world looks like. In the real world, what we do is we just go out and measure stuff. And that measurement process is going to take you quite far away from that object in the model.
Yeah.
So I think it's really important when we think about or talk about these issues, talk about productivity, are we talking about the productivity through the lens of the model? Like, is it like a thing like technology? Or do we mean, what do you get if you count up the amount of revenue that a firm makes and divide it by the number of workers it employs? Those are the two objects. The one that we really have in our mind is somewhere in between them, but they're not on the table. It's just like the thing you measure or the thing in the theory.
Yeah. Okay, a question for both of you. If you had to pick just one North Star metric that policymakers should be optimizing for, what would it be? So imagine you time travel, or you go into a coma or something, you wake up in 20 years' time. Like, say Anthony Albanese time travels 20 years into the future. What's the first thing he's asking for? Is it real GDP per capita, or what's the North Star metric?
Charlie Whelan in his Naked Economic books does exactly that thought experiment.
Oh, right? Really?
Yeah.
I haven't read them.
Yeah. He says,
do you know his answer?
I think the title of the chapter is, when you wake up from a coma, what should you ask? And his answer is GDP.
Just GDP?
GDP per capita or something.
Okay.
But I'm going to be annoying for a minute.
Go ahead.
I just think that's like you asked the best questions, Joe, but I just don't think that's a question for policymakers to be answered. Because if you go back to where I started, which is, what is it that we're trying to do? We're trying to improve the welfare of some group of people. It might be Australians, might be people more broadly.
Yeah.
It might be this generation, might be future generation. Ultimately, it's an aggregation exercise, and it's a big thing. And I think the mistake we make is exactly to look for one metric and then debate about whether it's the right metric. Of course, of course it's the wrong metric. My advice to policymakers is, no, keep your eye on a whole bunch of different things, because exactly, if you choose one North Star and focus on it, you're going to end up just maximizing that. And that is, remember, not a real thing. It's just a measurement that you took.
Yeah.
Yeah, all good points. Look, if you absolutely had to have one, if it's ex post, like if you're wanting to look backwards on the last 20 years or something, I think rather than GDP, I'd probably go for something that incorporates income, so something real disposable income growth per capita. So that would be your best proxy for welfare. But ex ante, if you're looking forward and you're asking the question, I can maximise one thing in this stylised world, I think you can do worse than GDP per capita. Of course, that is stylised and not right. I mean, and it might be subject to the odd big thing. So it might be that in the next 20 years, rational policymakers would say, well, the climate transition is something that has to be done, and that may or may not add to GDP per capita, partly because in reducing emissions, we're reducing a cost that has not been traditionally counted as part of our GDP. And therefore, a rise in GDP per capita is not the main game because it's subject to this big thing that we've got to achieve and for other reasons. But I think in normal times, if we're looking forward, I know how that comes across, but what else is there? There is no other good broad-based measure that's a reasonable approximation for how much better better off we are in material terms. Yeah.
But it's sort of strange to me because GDP was not something. It's not a fundamental thing. It's something it's a measurement that we came up with in the 1930s, right? Like we could come up with we could measure whatever we want, but ultimately whatever. Yeah.
So what did policymakers do before then?
Yeah.
What did Pitt the Younger? What did he regard as his fundamental object? Beating the French, I guess. But I mean, communities and their leaders had to have other, perhaps intangible indicators or I don't know, objects in mind. And it's a really interesting question. It does reflect something about how mechanistic we've become in the way we think about policy and the way we think about success.
Yeah. Conditional on caring about productivity growth, should policymakers look more at labour productivity or TFP?
Well, these are two very different things, so let's get them on the table. So if I think it depends, again, of why you're looking at productivity growth. So if what you're trying to do is get a proxy for something that more closely resembles household welfare, then labour productivity is much closer to that, right? What is labour productivity? It's how much stuff we produce divided by some measure of how much effort or work we put into producing it. It's kind of close to GDP per capita. Like the stuff on the top, how much is the output? Stuff on the bottom is how much went into it. So that's people. And so if what you really mean is like a euphemism for GDP per capita or how much stuff there is per person, then labour productivity. But if what you really want is a measure of how effectively or efficiently are we producing stuff, because we think that having more stuff will enable us to be able to do a lot more things and we're able to use that stuff, then TFP is a much better measure of how effectively we're producing. So if what we're trying to measure is kind of really productivity, how productive we are, or efficiency, well, TFP captures that better, but it's not necessarily a good measure of welfare. You're the productivity commissioner. Would you agree with that?
Look, I think TFP in a way is in theory the purer measure because it is distilling how much of this labour productivity did we effectively get out of capital deepening, and capital's not costless. And if you went back to the very early Austrian economists, they'd make the observation that there was a lot of labour effectively sort of congealed in the capital. It's just more roundabout mode of production, right? But I think the measurement issues are just so great, and I think that's part of the reason why you're observing the odd fall in measured TFP and that sort of thing. It looks very volatile. It's the challenge of measuring capital services. That's what you've really got to measure. Right. The capital input is distinct even from the capital stock.
Yeah,
that's quite difficult to do. It's quite stylised, quite open to interpretation. So for that reason, I think labour productivity as a kind of basic heuristic, GDP per hour worked, again, not perfect, subject to its own measurement issues, but probably a little bit less subject to the vagaries of really difficult measurement.
And would you say that's true even like a resource sector, resource producing economy like Australia? So you have big movements in the prices of resources. We use our minds more. Labour productivity looks like it moves around a lot because the level of labour input doesn't change too much.
Yeah, I think it is complicated in very capital intensive industries.
Yeah.
Certainly true. And TFP will bounce around a lot in those industries, right? Because you get these big cycles of capital investment, and you can see a trough in TFP as a result. Yeah, but I think yes.
So you get movements in TFP because of the investment cycle. You get movements in labour productivity because of the prices moving around.
Yeah, well, in theory,
utilization.
The labour productivity measure, you should be deflating fully for the price of the relevant commodity. So it's still, ultimately it is in theory a proxy for a physical measure, literally physical hours of labour, physical inputs in and physical output out, and what's the change in those things. And so in theory, it's abstracting from commodity prices. It's not abstracting from second round effects, right? So to the extent that prices are high, if it draws more resources into the sector, that can have effects on measured productivity. I think this is a point about, going back to my point about income versus GDP per capita. GDP is a production-based measure, whereas income is ultimately, what we get for it. The experience over the last 25 years in Australia has really confirmed the importance of prices in the Australian story. So when we think about even the 3 Ps of the intergenerational report, population, participation, productivity, it's kind of a 4th P, which is price. And price has been incredibly important to our success. Now, that makes it sound like it's all just good fortune, and there is a bit of good fortune in this. We happen to be a mining producer at a time when China rose and had big demand for our resources. There is something to be said, though, for the speed and nimbleness with which Australia was able to respond to that, with kind of minimal overall economic disruption. But yeah, prices are guiding a lot of the allocative decisions within the Australian economy in a way that productivity actually isn't. So yeah, I think you're understanding the role of prices both in allocation but also in overall welfare is pretty important.
So any other measurement issues that you really want to put on the table before we move on?
Yeah, I think there's one that we should mention. So if you go back to thinking about how do we actually measure GDP, oftentimes, so how do we measure productivity, sorry?
Yep.
Oftentimes what we do is we just look at GDP per worker. We say that's a pretty decent proxy for the whole economy of how much stuff people are producing. Right. But we often go further than that and also apply something similar at the individual firm level. And so you often will hear discussions about firm level productivity, with the idea being if we want to understand how does productivity operate at the aggregate level, let's look deeper into the individual firms in the economy. And there I think it becomes a little bit more challenging, because what actually we measure is something like revenue, so the amount of revenue a firm produces divided by the number of employees, so revenue per worker. And it feels sort of similar to doing it at the aggregate level, but it's actually very, very different, because there's many more different ways or reasons why a firm's revenue per worker could differ from one other firm's or grow over time, that get washed out when you aggregate all the firms together and look at the aggregate. So while these are both sort of imperfect proxies, it's a much less perfect proxy at the firm level. And maybe we can talk, and maybe you want to come back to it, but a little bit of the reasons why we should be careful about inferring too much from the data on so-called firm level productivity, revenue per worker, for what that means for policy and thinking about what the sources of overall aggregate productivity movements are.
Give me a couple of quick examples or reasons why we should be careful about that.
Yeah, so revenue per worker ultimately is just how much revenue you produce per worker you employ. Now, if I'm a high revenue per worker firm and you're a low revenue per worker firm, there are many different reasons why. It could be that we both produce exactly the same stuff, we produce the same amount of stuff, but I'm just much more effective at producing it. So it really is a productivity gain. But it could also be that I have a different, I've invested a different amount of capital in my firm than you. It could be that we operate in different product markets where the prices are different. It could be that you're able to charge a higher markup over your costs relative to your competitors. It could be that your marginal cost of production, so how much it would cost you to expand your production is different to mine. That would also be something that would generate differences in revenues per worker. And most of the time, it's that we're actually producing different stuff. Like it's only in very, very small subset of the economy that we can actually compare two firms and say they produce exactly the same good, and therefore any difference in revenue per worker, we can have a clear interpretation of it. Most of the time, we're just looking at dollars of stuff, and they're produced in very different ways. So it becomes much harder to know whether it is something about productivity or something about production or something about the market.
Great.
Can I give one example?
Yeah.
Like take software. If you're a software company, you can expand. The marginal cost of production in terms of workers is pretty small. Right? You sell an extra piece of software doesn't actually require any more workers. So if you were able to expand that, what does that tell you about productivity? Nothing in terms of like the technology interpretation that we gave earlier. But it certainly is a measured productivity increase. It's capturing something very different from if we were actually to look at a firm that was actually increasing its using higher technology, was allowing it to produce more stuff for each employee.
Great. Okay, so Michael, if you were Jim Chalmers listening to this conversation and you bought all of Greg's measurement critiques, is there anything you'd do differently tomorrow?
Not really, no. As I'm sure he has a high respect for Greg, but it's not, I think the question is, does any of it change your fundamental strategy? And I think the point is, you always take, Greg's right, you take these headline aggregates with a grain of salt. They're not the be-all and end-all. They're a pretty good heuristic, but they're not everything. The question is, can you replace a thing like GDP per capita or real incomes per capita or whatever with some other holistic, perfectly aggregated, but somehow more all-encompassing measure? And the answer is you can't, right? You can, there are the Human Development Index or these other things, and they're an attempt to bring in a measure for life expectancy, for equality of income, other things. I think you're better off just having, that aggregate and some other things that you really care about. Mm-hmm. Have a look at life expectancy. Have a look at whether it's your Gini coefficient or some other measure of the equality, the distribution of income. Have a look at incarceration rates among disadvantaged communities. Whatever it is that you want to highlight, but I think keep them fairly kind of almost segmented as a dashboard of indicators, rather than trying to heroically amalgamate these, kind of do another version of GDP, but, with a broader measure of welfare. I think where it really comes into sharp relief is more at the micro level. Obviously there are particular policy areas where prices don't fully reflect the costs or benefits of the activity concerned. And that's where policymakers, you do want to move away from the kind of, price equals marginal cost assumption. That's obviously true in respect of carbon emissions. It's true in relation to road congestion. It's true in relation to a whole bunch of other things. So I think often, policy, has to be open to where welfare or well-being departs from what's measurable or what's observed. But I don't think it's fruitful to try and bring it all together into some kind of magical index.
Okay. So I just want to quickly level set, and I think we can get through these next two topics in 5 minutes maximum. But firstly, I want to characterize the Australian economy, especially for any international listeners. And then secondly, I'll just give some quick statistics to provide a sort of health check on the Australian economy. So this is another question for you, Michael, but could you share some stylized facts about the Australian economy? So say you had a friend who was an economist, but maybe they're an American or someone overseas. They don't know anything about Australia. They call you up. What are like the first 3 to 5 bullet points you'd share about Australia?
I think it's a great question because I think fundamentally Australia is quite a distinctive developed economy. I think it's quite different to much of the rest of the developed world. There are 3 industries where Australia is a big outlier in the sense that we are hugely overweight in those industries as a share of our overall economy. One is mining. So very few developed economies have a big mining industry. Most developed economies have traditionally had a big manufacturing industry. Australia has not. We had more of a manufacturing industry, but it was always small and it's diminished. But mining is a big deal in Australia relative to other developed economies. But it's something we share in common with more emerging economies, right? But that means we have big exposure to commodity prices, and that leads to a degree of volatility in our budget, for example. And that's a macroeconomic management issue and fiscal management issue that Australia has that's a little bit distinct. The second industry where we are overweight is financial services, because we have effectively a privatised pension system. We have this large superannuation system, compulsory contributions made by employers on behalf of their workers that get invested on their behalf. So we now have got a funds management industry exceeding $4 trillion, well in excess of GDP, well in excess of the capitalisation of our stock exchange. So this is significant, and it's it's an outlier in terms of financial services as a share of GDP. And the third is construction, because we're a high immigration country, we're a high population growth country. It's not often well understood, even in Australia, just how much of an outlier we are in that respect, that we've having had population growth of at times 1.6, 1.7, 1.8%. Again, in the developed world, that is unusual. So construction is a larger share of our overall economy. And I think kind of accompanying those latter two, superannuation and housing as being these really significant assets that characterise household balance sheets, I think that is something that is particularly, if not unique to Australia, it's kind of distinct. The only other kind of things which are a little more intangible but go to the sort of policy and political culture of Australia are two things I'd point out. One is that we do have traditionally, unlike a lot of the developed world, but maybe we share this a bit with the Nordics and East Asia, but there is a kind of culture of fiscal prudence, for want of a better term, a view that governments really should balance the budget, debt should be low. As I say, much of the developed world, that's not a feature of the political culture really at all. It maybe has fragmented a bit in Australia, but traditionally this has been a key litmus test by which the success of governments has been measured.
Do you know where that comes from?
Maybe we've had a measure of success on that metric and sort of became embedded. It's certainly noticeably different to, say, the United States, but even I would say much of Western Europe, right? And the final thing is that there's, our social safety net looks a bit different. In one sense, we've got quite widespread, for example, labour market regulation, which kind of we have a relatively high minimum wage compared as a share of the average wage compared to the rest of the world. In another sense, though, our welfare safety net is a highly targeted thing, and that's a little different, again, to much of the OECD, particularly where they have unemployment insurance arrangements which are contributory and everyone's paying in and then they can draw down in the event of job loss. Our social safety net is a highly means-tested thing, and I think there is a very strong culture of means testing in Australia. Again, I think it's fragmenting a bit, but traditionally the idea that social assistance really should go primarily to low-income households, to people who really, quote, need it, I think that's been a really important part of the political culture. So I think that, as a result of which I think for, in the absence of unemployment insurance and that sort of thing, and perhaps the love of, the great Aussie love of housing, there is a bit of a sense in which for many purposes, Australia is a bit of a self-insurance economy. You ride out the volatilities of income or job loss or whatever, often largely through, the offset account, which is a distinctly Australian thing, the offset or the redraw on the house, drawing down on some of that accumulated wealth or whatever. Maybe this is part of the reason why there's so much politics in it. It's the buffer, it's the cushion. So I think there's a whole kind of research agenda around the modes of self-insurance in the Australian economy. But I think it's something that might be maybe a little bit distinctive in our place.
Neat summary. That's great. Okay, so my job now is to provide a quick status update on the health of the Australian economy. I guess this is maybe more for our international listeners. And again, to the extent I reference charts, we'll put these up in the video version of the episode. But for those who don't know, Australia is a country of about 27.5 million people. Last year, our GDP was about 1.75 trillion US, or about 2.6 trillion Aussie. In terms of GDP per capita, I think we rank about 9th in the OECD on a purchasing power parity basis. Labour productivity and TFP growth has been underwhelming, to say the least. So since the 2017-2018 fiscal year, both labour productivity and TFP growth have been only 0.2% per year. Real GDP per capita growth has been declining, you could say, since the turn of the century. This is a chart looking at the 5-year compound annual growth rate. And labour productivity has also been stagnating again, you could say, since the turn of the century. That's labour productivity growth. And that is the RBA's stuff. This table is probably a easier way to draw the comparison against the earlier period. So for the market sector, in the 2 decades to the 2017-18 fiscal year, labour productivity growth was 1.6% per year. But since 2017-18, it's been only 0.6%. Anything else you would add to that?
No, I guess just to return to the recurring theme in relation to GDP, average real GDP per capita growth, which was high around the early 2000s and then steadily declined. There was a part of that period where income growth nonetheless was pretty strong because of the terms of trade. Yeah. And that's in level terms, there's been, whilst it's fluctuated, but in level terms, the terms of trade are materially higher than they were in the 1990s, and that's in effect been the underpinnings of prosperity, largely given the poor contribution from productivity growth.
Yeah. Okay, so let's talk about goals and growth regimes. So I just have a couple of quick questions on what we could be aiming for and then what the downside might look like. I have another chart, which I will again put up in the video. So this is Australia's global rank measured by purchasing power parity adjusted GDP per capita over the last 2 centuries. So as economic historians know, Australia for a time was the richest country on earth in the late 19th century. Maybe this is just a silly question, but as a thought experiment, I wanted to ask, what would it take to reclaim that that top rank?
Well, it's interesting to think about how it came about. I mean, obviously a couple of big causal factors were growth of the pastoral industry, and where I guess land was the big thing that became pretty plentiful, obviously at the cost of dispossession of an indigenous population, but there was that input was able to be expanded significantly, and substantial growth, income growth, came in the form of off the back of the wool industry, and then gold from the 1850s onwards. When I reflect on Ian McLean's book about why Australia prospered, and he makes the point that the gold rush resulted in much more sustained prosperity than one might think, is consistent with a gold rush. So I think a couple of big industries that really provided some tailwinds. I think it was a period of global growth and openness, and we were linked to a massively expanding market in the United Kingdom, which was going through a period of very substantial income growth and industrialisation. But it is an interesting thing to ponder, just the success of that, economic success of that 19th century, particularly given that the big income growth that occurred in Western Europe really didn't start until the early 1800s. So it wasn't as though those who came in the 1780s had necessarily already experienced that big surge in income growth that then characterised the Western Europe and later the United States. I think also there were some good institutional choices that were made early on. There was a big debate about whether to extend in effect, to convert the pastoral leases that had been issued to squatters in Western New South Wales into freehold title. There was a lot of resistance to that, rightly, and it, I think, in many ways prevented the creation of a sort of oligarchic pastoral class. And I think that's part of the story of the success over that period, that there was a kind of a sense of democracy, a sense of maintaining institutions that were fairly egalitarian. And I think in economic terms, that also paid dividends. Could we achieve it again? I mean, that logic in part kind of reflects, you know, when did we slide down the rankings? Well, we slid down the rankings partly because some other countries developed, you know, and Singapore, and that's a great thing, right? Singapore, Taiwan, Japan, Germany, although neither of those, I think, outrank us at the moment in the per capita stakes. But, you know, it was important in that post-war period that much of the world recovered. I think when you look at our relative performance too, it's sort of hard to escape the conclusion that the 18th century largely characterised by agriculture, a bit of mining, much of the 19th century rather, much of the 20th century by manufacturing, and Australia didn't really catch the manufacturing wave in the same way that other economies did. It just wasn't, for whatever reason, it just wasn't our thing in the way that agriculture and mining were. When agriculture was the biggest industry in the world, we were number one. When manufacturing was the biggest industry in the world, you know, we were further down.
But we were still number 10.
Yeah, that's true.
And I think it's easy to look at 150 years ago and say we were number one. Wow, it's a failure since then. I think we also need to look at some of the other countries' performance over that period. I mean, Argentina is the one that comes to mind, but there's others that have taken another path from the same position.
Do we know what the highest growth regimes are that have been sustained by other frontier economies in recent decades?
Well, I think the key word there is frontier, right?
Yeah.
Yeah. And so the 2% number seems, over long periods of time, seems like a pretty hard number to get around. Just
2% real GDP growth.
That's the long term.
Yeah,
that's the long term number for the US.
Right.
And if you would think about that as being the frontier, now I may be less optimistic than others that's sustainable over long periods of time. If you put it in a much broader context, it's a pretty special period. But yeah, numbers like 5% seem difficult.
Okay, so what do you think is the most ambitious growth regime that Australia could plausibly aim for?
Should we be aiming for growth regimes? I mean, it feels to me a little bit like a 5-year plan. Like, you know, like these numbers are outputs, not inputs, right? They're the things that what we should aim for is let's remove all the impediments that we place to people producing in the most productive way. Let's foster whatever policies we can pay for government to foster that, and see where we land up. That seems to be a much more productive approach than to start putting targets in terms of these outcomes.
Okay, let me reframe the question. Say we make Michael Brennan and Greg Kaplan benevolent social planners, omnipotent social planners.
That's going to be a negative number.
And you implement the full suite of your agenda and you remove all of the impediments that you're worried about. What kind of ballpark or range do you think we could get to in terms of our real GDP growth?
I will come at a number just to humour you, Joe.
Thank you.
Because I'm a pleaser, but there's a lot of truth in what Greg says, and there's a lot of contingency in it, right? So when you look over the broad sweep of history, what's driven productivity growth, a lot of it is technology broadly conceived. So the pace of technological change, and of course that includes everything from high-end, what we think of as, complex technologies right through to the, quote, invention of the shipping container, which is not really an invention at all, but it's an economic innovation, right? It was a coordination issue, but it's led to huge efficiency and, trade, which is been a huge source of productivity growth, countries like Australia. So in a way, it's the pace of those sorts of things that come along, and then it's really an economy's ability to adapt to that, adopt it, et cetera. So there is, you think of Robert Gordon's thesis, it might just be that the pace of technological change has slowed, that's just a reality, and that's going to place a limit on how fast productivity growth can be, kind of irrespective of the policy and institutional settings that a country's got. But logically, you would think, if you were after a number, you would go back to the sorts of numbers that we achieved in the second half of the 1990s as being ballpark. You know, if you feel that you've got your policy settings right, your broad kind of institutions of openness and adaptability, and you've got a technology that's there for the taking in the way that ICT perhaps was in the 90s and potentially AI today, and maybe other things. Yeah, it feels like that's the sort of growth rate that it's not unreasonable for an economy to aspire to.
So what was the growth rate?
So it'd be sort of labour productivity growth of these orders of magnitude, right?
Like 1 to 2%.
Yeah, 1 to 2%. Yeah.
Got it. Okay. So again, this question might be better answered by a spreadsheet than a podcast, but say we continue with our disappointing productivity growth of 0.2% per year. Do you know how much GDP we'll miss out on roughly in say a decade's time relative to a counterfactual of more like 1 to 2%?
So you're asking what's
the compound
difference to the power of whatever the labour share is, I guess. So the labour.
Greg, can you just quickly work that out in your head?
Look, I don't know the number. Okay. Someone can, but it's substantial.
Over 10 years?
Yeah.
Yeah. It might be like 30, 40, 50%, something like that. Yeah.
Well, I mean, to back of the end, what are we talking? 1.5% per year? Is that
potentially?
Yeah. No, 10 years, it's 20% or so.
Yeah, okay. So it's significant.
Yeah.
Okay. So let's talk about what's causing the productivity crisis and then some different ideas to fix it. So tell me, just as a starting point, tell me what's wrong with this view. The punchline is that the crisis is, if not non-existent, at least greatly overstated. And the argument relies on 3 points. And Dietrich Vollrath, the American economist, is most famous for making this argument in the American context. I'm just stealing it and applying it to the Australian context. But the first step in the argument is that, look, services industries are going to tend to be lower productivity than goods industries. And that's because of this intrinsic quality whereby services tend to involve labour. And eking out productivity gains from labour is difficult, has diminishing returns because you're constrained by the scope of people's time and attention. So the classic example is like the listening to the string quartet. If they're playing a 30-minute piece of music, you don't want to hear that in 12 minutes. That 30 minutes is going to be pretty fixed across the centuries or the decades. So that's the first point. The second is the price of services as a result of that first point will tend to rise relative to goods. This is also known as Baumol's cost disease. And then the third observation is that more economic activity, or the third prediction rather, is that more economic activity will shift into services because our demand for services is income elastic, whereas our demand for goods is income inelastic. And we see this in the data. If you look at the size of Australia's service sector as a value-added share of Australian GDP, it's grown rapidly in the last several decades. At the moment, it's about 80% of GDP. This chart is actually from the Productivity Commission in 2021. So, Michael, this was when you were chair, I think. So I'm giving you your own research. Look at this research I've done. So in this view, the productivity slowdown just reflects a shift in consumption from goods, which we've gotten really good at producing, to services, which are lower productivity. And that slowdown is just an artifact of how productivity is measured. We wouldn't be better off if we reversed it. So everyone just needs to calm down, carry on. There's no productivity crisis. There's no need for huge roundtables. This is just what happens to a mature economy. So what's wrong with that view?
Well, I think it's a perfectly reasonable hypothesis, and every premise there makes sense. But it's an empirical question at the end of the day. and I'll get Michael's view, but my understanding is that it's just not borne out in the data. That I think that it's clearly definitely part of it. We're shifting towards low productivity sectors, and some of those sectors are also outside of the market as well, which has contributed as well. But my understanding is that if we look within sectors, there's been big productivity slowdowns even within those sectors, within service sectors. So you could do a within between decomposition of changes in productivity. And my understanding is that most of the changes within sectors, not across sectors. So yes, but it just doesn't account for empirically a huge fraction. I know we've done some work at E61 on this.
We've done a bit on.
I know the RBA's done some that I've seen as well.
Yeah, the rise of the care economy, and it does two things. So the shift in composition of the workforce towards sectors with low levels of productivity obviously has a compositional effect, reduces overall productivity growth, but it also there's a question about the ongoing productivity growth in these sectors as well. Like, I think the cost disease story is pretty compelling as a set of stylized facts as a starting point, but I wouldn't necessarily read into it that therefore, quote, there's no problem. I think it does help qualify it a bit, but to me it more just sort of characterises a bit of the nature of the challenge. The string quartet's interesting because this kind of goes to, can services be automated? Can we achieve some productivity growth in these services? And the string quartet's kind of instructive because the original intent of that metaphor was obviously, well, you can't just automate the cellist. So it's not like manufacturing where you just can strip out labour and replace it with capital. So you can't. You still need 4 people in a string quartet. But what is interesting is we have now had technological advancements that mean that people can hear that string quartet. 1 billion people could hear that string quartet.
That's exactly right.
Rather than 100 sitting in an auditorium. So
it's a failure of imagination to say that services really do depend on labour as much as they historically have.
It's about how you measure output.
Okay.
So what is so Baumol's idea is brilliant. He's saying the measure of output there is the 30 seconds of producing the music out to the world. An alternative potential measure of output there would be the receipt of that music by a set of ears.
Right.
And so now how much you produce depends on the size of the auditorium, in which case one would say that maybe that sector, actually there's been more productivity growth than almost any other sector that you can think of.
Okay.
Right?
But then you can pick other examples where there are constraints.
Oh, totally.
Like,
of course.
I'm not
absolutely.
Teachers and doctors.
But the point is to say that it's that innovation in services is not impossible.
Yep.
And if the one thing that we've learned from the AI changes that we're seeing is that, that's going to happen. Hard to predict where and how much, but it's not a God-given truth that services can't be produced more effectively.
I mean, this is I don't know how far this gets us, right, but just bear with me for a moment. In a way you can think of, so the string quartet, good example, think of a lot of household chores. It's interesting to reflect. In one sense, the service economy was probably bigger in the 19th century than it is today, where, kind of the share of time spent on people doing stuff, it was a service-dominated economy. As this blue line reflects here, it's that services got kind of replaced by goods in a way via manufacturing. So a lot of the service of going, having 4 people play a string quartet for you in the auditorium, that got kind of replaced by a record and a record player. So the ability of manufacturing to step in and create a substitute for the service, or in the case of household chores, a dishwasher and a washing machine and so the manufacturing industry kind of came in and, manufacturing these things got cheaper and cheaper over time because we're able to kind of automate that process. Part of what's gone on in more recent times, you think of the music examples, we've actually gone back towards a service in a sense. We've got, you no longer buy CDs, records, that sort of thing. We now have phones and it's a streaming service, which kind of, the point being, maybe you can't forever manufacture away what is fundamentally a service. I don't know. That's an unproven thesis, right? But interesting to think about. The thing that I think is relevant to the services sector, and this is, again, a forward-looking thought experiment, but I look at agriculture here. That was, it's extraordinary, right, to think in the 19th century that was 60% of the economy, of the measured economy at least. At the turn of the century, 1900, okay, so it's down to about 25%, but it was about 25% of the workforce as well. It's now about, 4 or 5% of the workforce. The output is hugely increased. So we are producing vastly more wheat and fibre and food than we were in the 1900s. But we're doing it with many fewer people. And that's part of the, quote, cost disease story, is that's the labour that was freed up by those highly efficient, highly productive industries to sort of flow into other things that we decided we wanted, many of which are services. So it is interesting, I guess, to reflect now. You think of our biggest employing industries like health and social assistance, education, some of these, and think, okay, so would we plausibly expect over the next 100 years that they're going to have a big productivity surge that's going to translate into shedding labour at the same rate, where it's going to go into other sectors? And it might, but at this point in time, it's hard to envisage. But maybe that's always true. Maybe it's always hard to envisage how labour could be massively liberated. I think this is partly your point about elasticity. If health improves a lot in quality, we're just still going to want more, because it's just a natural thing. Why wouldn't you? More life, more quality life. Whereas some of these goods, more inelastic, maybe once they get cheaper, you want something different. But so I think it is an interesting question. Are we going to see the same pattern in some of our modern service sectors that we observed in, say, agricultural and manufacturing?
Maybe I'll just add one observation. Now, underlying this is a blue line here, the service line. The two biggest, I think this is right, the two biggest sectors there are health services and financial services, maybe education services as well. Health and financial services are two sectors where the productivity measurement issues are probably most pronounced. And Michael focused on the denominator, so the labour coming in and out. I think as big a challenge is the numerator. So output, how do you define output in the financial services sector? What is it it's very, very difficult. So it's some form of revenue. It is producing some value by maybe more efficiently allocating capital, allowing people to insure over time. Those are very abstract concepts that are very hard to measure. Same thing goes with health care. I mean, ultimately what we're measuring there is going to be something with dollars on the top. But if we're getting better health outcomes, that's something that's very hard to get into the productivity statistics. Would you agree with that?
Absolutely. Yeah. Well, all of which sort of, I kind of agree with the basic premise that you're putting, Joe. It's like unclear, how big is the problem?
Yeah.
But I think if, at least I would say this, if productivity growth looks different in the future to what it looked like in the past, including this, that more of it is quality, hard to observe, et cetera, the demand for these services pretty elastic, then I think it does have implications for some of the things that we have asked of productivity growth. Like, for example, productivity growth has been the way that our fiscal arithmetic has added up, right? It's allowed governments to expand service delivery at a rate that exceeds population growth and inflation, and still have the revenue to cover it, because revenues will grow roughly in line with the economy. So if there's productivity growth, it sort of gives you a bit of fiscal wherewithal. The story you're telling, if it's right and it's not clear that we're going to get big real cost reductions in these services, these things aren't going to become radically cheaper over time, then some of that fiscal arithmetic becomes challenging. So even if it's not a problem in terms of overall well-being and that sort of thing, it just changes the nature of what dividend we're going to get from productivity growth. And I think that's still a challenge, right?
Yeah. Okay. So on that, actually, just quickly, so I'm super clear, the services Baumol's cost disease story is true, but the effect just isn't large enough to explain all of Australia's, or most of Australia's productivity slowdown.
Yeah, I think it's part of the story.
Part of the story, but not the dominant explanation.
Yeah, I think that's probably right.
Okay. So just while we're on the topic of services, what do you see as the lowest hanging fruit for getting productivity or quality improvements in services?
Yeah, it's if I think about that conceptually, and this is me playing in my benign dictatorship or whatever, so now I've got complete, not just control over government, but I'm actually running the economy, 1940s style Soviet era. I think when I think about emerging technologies, it's got its political challenges, got its implementation challenges, but it's really not impossible to envisage use cases in health and education for AI that are pretty obviously productivity enhancing, potentially labour saving, quality enhancing. It's much harder in disability, maybe, and in aged care and in childcare. There are still services where it's going to be difficult, I think, to achieve the sort of productivity growth that we observed in agriculture and mining. As you know, there would be political and stakeholder difficulties, but I would have thought there is very substantial scope for technological adoption in those sectors.
I mean, not to be too crass, but if you kind of think about what a GP does, which is essentially like pattern matching and then giving a fairly pro forma prescription, like a lot of that you can see being at least assisted by, if not substituted for, by things like LLMs.
Yeah, I think you could see a world in which a GP could achieve very similar health outcomes in less time for a larger group of patients.
Yeah. Okay, so just
I'm going to ask a question about this. So maybe I misunderstood the question. So that's an answer that's really about how I'd love the economy to look, as opposed to what maybe we should do as governments. Is that what I'm not sure if that's what you were trying to get at, but thinking about that sort of harder question of, okay, so how do we enable that? What is the role of government in getting us to that? Would you say, Michael, that one might be moving some of these service sectors in Australia that are sort of done outside of the market back to the market, so that we could get some of the competitive pressures that would be needed to adopt these technologies?
Feels like a leading question.
Yeah, I think
the answer might be no, in which case.
Well,
you don't know the answer?
No. I think it's a qualified. I think it's a qualified yes. So there are instances where I think, you can imagine these use cases, and then you think, but the incentives aren't really there, and it's not for me to determine. You're quite right, for me to determine what GPs or teachers or education czars should be doing. But there are instances where the incentives just don't align with that. Mm-hmm. So some of the incentives are about whether something is operating in a market or not. Sometimes it's about the design of that market. I mean, the reality with GPs is they are remunerated on the basis of the time they spend with a patient. So, it's a consultation of specified length. And so that is a barrier to wanting to, as I put it, treat more patients at higher quality in less time. In other instances, if you've got a school system, for example, and you want to inject more technology, well, that becomes partly you've got to sort of drive that through the system. But I wouldn't be surprised if we see a fair bit of disruption from the private sector in tutoring. It's not impossible that other countries, adopt technology rapidly because they don't feel they've got a high quality teaching workforce, and they achieve better educational outcomes as a result. So, I think there are paths of disruption, but there are barriers to it as well.
So maybe let me pare back the question a little bit. Sorry, am I allowed to?
No, go.
So these are sectors in which the government plays a big role, at least in Australia and in most countries, healthcare and education. We think there's good reasons why they don't operate in a pure market-based economy. Instead, we set up some form of quasi-market where we set rules and create how that quasi-market is going to operate. Is the point here that if we want to enable the types of technology adoption that we think are going to drive productivity going forward, that the role for government is to step back and rethink about how we organize those markets, given that the answer is not going to be let's get out of them completely. There's very good reasons for why we intervene in those markets that are not going to be cured by AI. So it's not going to be that we don't need any government intervention in healthcare or in education, but it's just that the type of intervention we need is different and the trade-offs are different. You gave a perfect example there, Michael, with the idea of time maybe not being the way that we remunerate GPs. There's no reason why that has to be the case. It's not a market outcome. It's a rule.
It's a funding model.
Yeah, it's a funding model. But is that maybe where governments should be focusing their attention in terms of productivity gains in the service industry?
Yeah, I think it's the age-old admonition to government of just think about what are the barriers, and do I have a rule or do I have a regulation or a funding model or just a rigidity that might stand in the way of the operation of a different business model or a technologically enabled alternative.
Okay. One more question and then I'll move to a different kind of segment. I'm just curious, to what extent do you think the causes of Australia's productivity slowdown are for Australia's specific reasons versus frontier-wide reasons that are sort of plaguing all the other frontier economies?
It's got to be a bit of both, right? Like, I mean, productivity growth has slowed the world over. And so it's hard to say this is a unique Australian phenomenon. And I think it's possible we lose sight of that in Australia because we had a period of what we now historically regard as an important and distinct period of economic reform in the 80s and 90s, early 2000s perhaps, that yielded productivity growth, and we feel we don't have that anymore. And so we have a bit of a tendency to tell an Australian-only story, ignoring the fact that this is a global phenomenon and it could be in part about either common causes in individual economies or a universal cause like a slowdown in technology. I'd be interested in Greg's views on this. You spend a lot of time in the US. Again, this is just a kind of personal reflection born of many years in this game. But I think in around the mid to late 1990s, there was still a lot of commentary at that point to the effect that maybe Europe had developed a kind of economic model that was ultimately superior to that of the United States. Maybe they would achieve, similar levels of prosperity, but with greater equality and, less of the sharp edges. And I look at it now and I just think that case is getting harder and harder to make.
Absolutely.
There is something, it's harder and harder to ignore this divergence that we have seen between, and we used to believe in convergence as a explanatory factor in it. Right. Development economics, that poor countries will catch up. It was hard for the richest countries to grow fast, but this gap that exists now even in recent times between the US and Europe, even the US and Canada, the US and Australia, I feel that it's getting hard to ignore. And that so that does imply that there's something that many of us need to reflect on about what might be missing in our approach or our economic model. I don't know what you think, Greg.
Yeah, I think that's right. I think that there are, I would call the horizontal differences in choices that countries have made that are becoming starker. And so, yes, but some of those differences that you're pointing out between Europe on the one hand and the US on the other hand are sort of partly compensated in some ways by other choices that those countries have made that I think come back to these initial questions that we were talking about is about what are we actually maximizing for here? And it's hard to critique those trade-offs because those are choices. Now, does that mean that one can't achieve sort of US levels of productivity with European levels of equality and our unique Australian culture? I don't see why not, but it's a very different thing to aspire to that than to point to what are the actual role for government and policies to make. I mean, getting out of the way while you're unnecessarily in the way seems to me the easiest one that I think the US for a while was doing very well at, and I think now it's not as clear. That we'll see what happens in the next few years. But yeah, it's a good observation.
I was wondering if you could humor me again. Like, what do you think is the relative importance of the Australia-specific causes for the slowdown versus the frontier-wide causes?
I'm going to say it's at least half frontier-wide.
Yeah, I was going to say 50-50 minimum.
Yeah, okay, cool. At a first approximation. Yep. Yeah. Okay. Yeah. So the next thing I want to talk about is what we can learn from firms, industries, countries that are currently performing really well in terms of productivity growth. So this is me using common sense and winging it a bit. Maybe it comes across as either too obvious or too simplistic to you guys, especially given your deep public policy experience, Michael. But if I were a policymaker trying to get productivity growth going again in Australia, one of the first places I might look is, okay, which industries have been doing well, which have been doing poorly, which firms have been doing well, which countries have been doing well, and then see if there are any ideas I could borrow to apply to the laggards. So as a starting point, does this approach sound reasonable?
Yeah, I'm with you so far. I think it potentially got its limitations, but I think there are some lessons to be drawn. Yeah. What do you think, Greg? Oh, I'm being too benign.
Maybe. I think that obviously those are things to look at. I still have maybe it's the Chicago in me. I just have something against this idea that we can will ourselves into higher productivity and better outcomes. Like that, it's not that idea of looking at the outputs and saying, well, the output is they're doing well over there, they're not doing well over there. So let's try get the guys that are doing that to do like that. That's just not how I think about how an economy works. Those are outputs. What we can control as policymakers are the settings by which private actors make input choices. And so my starting point would be to look at what are all the barriers that are preventing people from doing the things that they want to do and that are making it hard to either adopt technologies or have best practice outputs, and then go from the input side.
Yeah, that makes sense. Well, we can. I mean, if I was a policymaker, I would maybe look from both directions, like the top down and the bottom up.
I'm not saying you shouldn't look. I mean, it's good to know what you need. You got to avoid falling into the trap of looking at outcomes and then saying, well, we need all firms to be more like that firm over there.
Right. Okay. Well, let's just humor me, and we can come back to that more bottom up approach after this. But to start with industries, like what industries have been doing well, what industries have been doing poorly in Australia. Again, just to sense check with you both, if I were a policymaker, I think I would be much more interested in growth rather than levels. Does that sound reasonable?
Yeah, it does to me.
Cool. Okay. So, Greg, any objections? Okay.
No objections.
So, over the weekend, Kevin Fox, the economist at UNSW, shared his latest charts with me, which are based on the ABS multi-factor productivity data. So shout out to Kevin and shout out to the ABS.
So shout out to University of New South Wales, with whom we have a partnership at the D61.
Absolutely. So that partnership launched a few months ago. We'll look through this again on the video. I'll put this chart up. But we've got 12 core industries in the Australian market sector. And this chart shows their total factor productivity growth from index to 1990. So the best performing sectors in terms of total factor productivity growth are firstly agriculture, forestry and fishing, secondly information, media and telecommunications, and thirdly financial and insurance services. And the three worst performers, starting with the absolute worst performer, firstly, electricity, gas, water and waste services, secondly, mining, and thirdly, construction. So first question, the standout, like the star in terms of productivity, total factor productivity growth performance over the last 3.5 decades is agriculture, forestry, and fishing. And my understanding is that the component there that has done the best is agriculture. Do we know why that has gone gangbusters?
I know a couple of reasons, some which aren't to do with productivity per se, but it is dependent a bit on weather conditions. Now, that doesn't explain a secular trend, but drought versus good rain conditions, those are inputs that aren't measured in the productivity stats. So obviously there's something going on there.
So just to dwell on that for a moment, drought is an unmeasured input that is going to
depress output.
So that's going to deflate the numerator.
That's right, without deflating the denominator. So it's going to make productivity look poor, and good conditions will make productivity look great.
Can I just add, just to double on that? If you stare at the figure, maybe viewers can see it, it has grown the most. It's also by far the most volatile.
Mm-hmm.
Yeah.
I think that maps to those periods of drought and good weather.
I think that's exactly right.
Yeah.
But, has agriculture done well? I reckon it has. I think it's hard to pin down causal factors here, but I think there has been a degree of rationalisation in the sector over this period. There is a little bit more scale in farming than there's been in the past. Farming is a much more professionalised sector. Farm management, even in instances where the farm passes down in a hereditary way through the family, younger generations coming into farming typically have got much stronger managerial skills. They've studied it. So I think the management of farm enterprises has changed, and I think it's quite different to what it was in 1990. The scale of farming, because there has been more rationalisation. But I think it's also a story of it has been much the continuation of that trend that we talked about over the last 100 years. It's the continued application of scientific progress to this sector, and it's been particularly amenable to it.
Better fertilisers, better seed varieties.
Yeah.
Things like
right.
that.
Yeah. Just the two things that I think are, and this goes a bit to your point, Greg, you can't always copy and paste from one sector to another, but it might give you a bit of a clue as to what some other sectors might be missing, and doesn't necessarily tell you what you do about it. But there are two things about agriculture. One is that it's internationally exposed. So it's a globally exposed business. You got no pricing power for the most part. Some vineyards might, and some other niche products, but for the most part, wool, beef, cattle, etc. Wheat, cattle. They don't have pricing power. They're selling into a global market. They're price takers. You've got no alternative but to just drive productivity on farm. That's how you make money. That's how you make margin. You can't do it through price or better marketing or whatever, really. The other thing is, I think we've had a pretty effective innovation system in agriculture. It's often rested on a lot of public R&D or R&D that's collectively funded by the farmers, paying a levy and funding the wool R&D corporation or CSIRO or whomever, and then a system of extension officers that often kind of gone out and sort of encourage farmers to take things up and spread good ideas, help diffuse. That's right. Yeah. And I think part of what has aided that, this is pure conjecture, but the farmers generally are not really competitors. They're selling their product on a global market, but they're not fighting for market share among themselves or anything like that. So I think that culture of sharing information in the land care group, just around town, whatever it is, I think that's pretty established in that sector, and that's probably aided the diffusion of ideas. And that's not, to your point, Greg, it's not to say, well, everybody should do that. Well, they can't all just do that, right? That's a thing that's probably distinctive about that industry. But it might be that there are a couple of these other sectors where that innovation system is less well developed, and particularly the ones where government's involved, maybe the government wants to think a little about how you could foster a better innovation diffusion system.
Yeah.
Would it be right to look at this chart and say, to take the bottom one, that's electricity, gas, water, and waste services, you're not exposed to international competition, and it's an area with more highly regulated, would you say?
Yeah.
Yeah.
A highly regulated pricing, and in a way, this is areas where the economic regulator plays a big role in determining what investment can take place, because you take an investment proposition to the pricing regulator to have it allowed in your regulated asset base. And I think it's true that we have, in a couple of those areas, gone a little harder on capital investment over part of the last 20, 25 years in electricity, say, because we were interested in reliability more so than cost in a couple of instances, big transmission upgrades, et cetera. So that's feeding into the MFP or TFP figures a bit, that there's just more capital that's gone in some cases.
I see. What about mining?
That's going to be my question. What about mining? It's kind of shockingly surprising to me. They've got the international competition, but according to this, we're less effective at producing than we were 25 years ago. Doesn't that not pass the smell test?
It's capital intensive. It's something Australia prides itself on. Like, why is TFP growth being so...
Before we even try and get into that, like, does it pass the smell? Like, I mean, I'm not going to doubt ABS or Kevin's numbers, but it just goes back to are we capturing the thing that we were trying to capture? This is a well-defined measurement. There's what rules about how you measure it. Then there's the object in our model, which is, you gave the example of just forgetting blueprints. So let's be careful about interpreting this as forgetting blueprints, because it suggests that we're 20% less than worse off at actually producing mining output than we were 25 years ago. How could that be?
Well, I think the clue is the period over which it declines, and it declines basically from the early 2000s, which is the time when prices really went up. And I think that's telling the story, because remembering this is a measure that abstracts from prices, so it deflates away a price increase, so because trying to get at physical output. It's quite plausible that the measured productivity of the mining sector is down because we've got more capital and more labour going into it for some increase in output, but maybe the increase in output hasn't quite been commensurate, but it's still highly profitable because the prices are so good. And so you wouldn't not want to do it. The investment of labour and capital from a macroeconomic perspective is good. The nation is richer for it, but the measured productivity comes down. And this is an instance where I think it's an important piece of information, but it's not necessarily the whole story.
Right.
So maybe policymakers don't look at mining productivity measures and try to draw too much from that.
Yeah. Okay. So just a quick check for completeness. We've spoken about maybe learning some things from agriculture around how they diffuse ideas. Are there any other things we could learn from the best performers to apply to the poorer performing industries?
It's hard to say. A couple of the ones like financial and insurance services, which is up there, it's just a big problem there measuring the output. The value add in the financial sector, what is it? Is it the net interest margin that a bank makes? Is it the insurance premium that a insurer charges? Is it the superannuation fees that a fund charges? They're the sort of proxies that we're generally reduced to try and get a handle on what's the output. And I think that's the challenge. It's not. There's been productivity in finance. I mean, we bank on these things now. We don't go into branches. We don't spend our time at ATMs. There is definitely, considerable productivity growth. But I just think it's really hard to measure it. And I worry a bit that part of what's driving that growth is just the growth of the industry itself, actually, indirectly. But who knows?
All right. Here's Kevin's second chart. So this is comparing the red bars are the 2003-4 fiscal period up to 23-24, so the last couple of decades, and then the blue bars are the sort of 15 years prior to that, so from 89-90 to 2003-4. So what you'll see in this chart is that there's been a TFP growth slowdown in 11 out of the 12 market sectors since 2004. The exception is arts and recreation services, although the magnitudes there are not so large that I think you would want to place too much weight on or interest in that. So the fact that we've had this TFP growth slowdown across almost all sectors over the last couple of decades suggests that there must be some common causes.
But is this saying that this figure here, we're just measuring the slope of this line over the first half compared with the slope of this line over the second part?
So it's the average percent growth, I think, per year.
Yeah. So I think that's what it is.
Yeah.
I mean, again, to me, this is one of those examples where, look, it's great. It's great to take summary statistics and use them, but you look what's underneath that, and it's just a mess of lines. Like I don't know. I was going to say, if I look across these sectors, I'm really skeptical about the measurement. Again, it's got nothing to do with how well we try and do this, but there's about three, maybe four of these sectors where I think you can even start to conceptualize what it is you're trying to measure before you get to the question of, can you actually then measure it? The other ones, it's not even clear. Michael just gave the example. It's not even clear what it is you're trying to measure in financial services or arts and recreation. So why are we comparing it? And then what we're not doing is weighting these by how important they are. Because then when you weight them, it's all the stuff that matters for the overall economy is the ones that we don't really want to be paying much attention to in figures in charts like this.
Okay.
But there's something in Joe's observation, isn't there? Well, if it tells you nothing else, it tells you something about whatever's going on. It might be more broadly based.
Right.
You know, if it was some were going up, some were going down. It's a bit your point about, is cost disease the big story here? And your observation, Greg, was, well, it feels as though there's a productivity reduction within sector. This looks like some vindication of that view.
I don't know, maybe, but that second half all has 2020 in it, and 2020 across all of them sort of dips down. That's got to count for something. It's also got 2008 in it, in all of them, where it dips down. I don't know, maybe. Or maybe there's just what it is. We have one time series, and maybe that's just what it looks like. Let's not overread into it. I don't know.
What do you, if you started from the assumption that there's some kind of common cause or set of causes slowing down TFP growth across all these industries, what's the most obvious candidate explanation?
I think it's hard. I mean, it's hard to find the thing that changed around that time, or has been in continuous change. Are we a more regulated economy?
Yeah, but it's not going to be in every one of these sectors. So it's like by virtue of looking for something that's across every sector rules out a lot of stuff.
Okay, here's one idea. You take a general purpose technology, which by definition is pervasive, so something like the ICT revolution, and then you say that had helped lift productivity growth because it's pervasive across all these sectors, but then the effects of that had sort of petered out by the turn of the century.
Yeah, I think that's a plausible explanation. It's probably the only one, because it's almost by definition has to be something that's pervasive, has to be general. What are you left with?
I don't know. You can't tell a regulatory story.
Not really.
You could tell
you could say we've just become way worse at getting in the way of firms, but how could that be true in every sector?
You could tell like a deeper ideas getting harder to find story, but I don't think that's plausible.
And it's also not that deeply different from the GPT story.
But also just empirically, I don't think the ideas getting harder to find story checks out, because you would need to show that the effort we're putting into research had also dropped, and I'm not sure it happened.
But I mean, we've got a great test of this hypothesis coming up over the I guess there's going to be the green bars that come up over the next 20 years. We have a GPT's just been developed.
Yeah.
So either this story's right or it's not. We'll see what happens.
a literal GPT in this case.
Yeah.
This episode is sponsored by Vanta. Trust isn't just earned, it's demanded. Whether you're a startup founder navigating your first audit or a seasoned security professional scaling your GRC program, proving your commitment to security has never been more critical or more complex. That's where Vanta comes in. Businesses use Vanta to establish trust by automating compliance needs over 35 frameworks like SOC 2 and ISO 27001, centralized security workflows, complete questionnaires up to 5 times faster, and proactively manage vendor risk. I have personal experience here. Startups I've worked at have used Vanta, and I've always found it reliable. Vanta can help you start or scale your security program by connecting you with auditors and experts to conduct your audit and set up your security program quickly. Plus, with automation and AI throughout the platform, Vanta gives you time back so you can focus on building your company. Join over 9,000 global companies like Atlassian, Dovetail, and FireAnt who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/Joe. That's VANTA.com/JOE for $1,000 off. Okay, so let's look at the firm level now. And this feels like a silly question. It actually feels like a doubly silly question because, Greg, you've just taught us about the measurement issues with looking at revenue per employee. But do we know what Australia's single most productive company is? Or companies?
Single highest revenue per worker?
I guess.
Well, it exists, but I don't know.
It's probably a shell company somewhere with zero work. I mean, who knows? Yeah, I don't know. I mean, by definition, a maximum exists.
But hard to know. So it would be interesting to hypothesize what would it be. So it could be a firm that is built around, it could be a very small firm that's built around some exceptional individuals, right? In, say, I don't know, software licensing or something, right?
So something with low marginal costs.
Yeah, and but potentially very high revenue. It could be a firm that has high revenue per employee because it operates with a kind of regulatory moat, like it's a casino and it's got a casino license or something. Right. Or it could be a large company that's selling goods to people and just does it very efficiently. But yeah, it would be, that's part of the challenge, I think, in interrogating the data, right?
Is you want to know why.
Yeah.
Yeah, if you really want to, I don't know, maybe I'm getting us a little bit off track here, but you want to deep down into what some of the underlying issues facing Australia, probably the technically correct answer to that is it's an investment shell company invested in property that has a revenue per worker of zero or infinite because it has zero employees and it counts for generating a huge amount of revenue. And there's a lot of them.
Yeah,
I'm being a bit condescending here, but I mean,
so cynical.
But I think it kind of gets to some of the deeper productivity issues.
Yep. Okay. So, do we know which Australian industries have the biggest productivity gaps between the frontier and the laggard companies within that same industry?
So I don't think we have. We've certainly never put anything out on that, but in principle we could, right? You could assess that.
Sorry, when you say we haven't put anything out,
E61.
E61.
Yeah.
Okay.
But it's something we've looked at in the aggregate, and yes, you could in theory do it by sector. Again, there's a kind of interesting question about what does it tell you. So there would be some sectors where there is not much of a gap between frontier and laggard. There's just a greater compression, smaller standard deviation around the mean. What is that? That could be consistent with a story that says there's really good diffusion. It could also be consistent with a story that says there's not much innovation. And equally, where you do observe a big gap, it could be that it's the converse. That could be a story that there's very poor diffusion, but it could be that that's where there's rampant innovation, right? And firms are, shooting ahead. And so at any point in time, there's some real superstars. Now you could look at it over time, I guess, and through time and see whether it's changing. I'm kind of reminded of Arnold Harberger in his presidential address to the American Economic Association. I think it was the presidential address, talked about whether productivity growth, his metaphor was, does it look like yeast or does it look like mushrooms? Yeast being, everything sort of rises steadily by the same sort of amount, year on year. Mushrooms being, there's just
fits and
stuff going on, fits and spurts. Yeah, some weird things sort of sprouting up. And his conclusion was, when you look at the data, it's much more mushroom-like than it is yeast-like. And
No, I think that's right. I'm going to give the cynical view again, but I think this is really important. So there's a lot of work that we can do now on looking at these measures across firms. The thing that you measure is revenue per worker. That's what we mean by productivity. And there's a huge amount of variation across firms within industries. And it's also true that if you look at longer run averages of that, so extract like a persistent component to get rid of some of these, there's still huge amounts of variation across firms. Now, what I find really interesting about this conversation that we're having is that there is an underlying sense that high revenue per worker firm is a good firm and a low revenue per worker firm is a bad firm, high productivity, low productivity. So maybe some listeners will find it surprising that the way that data has been interpreted over the last 10 years or so, and it's been interpreted a lot, is exactly the opposite to that. And it's played the role in the outcome of even policy discussions in Australia and policy changes in Australia, but been really important all over the world. And that's to interpret those differences as markups, as reflecting differences in an ability to extract revenue from your customers for the same amount of inputs.
Market power.
So here's what we can all agree on, because this is just data. If you take the distribution of firms, either in the US or in Australia, there's a huge amount of variation. The mean in that revenue per worker has gone up a lot over time. That increase over time has been driven by the firms at the top getting bigger. So some firms being driven who generate high amounts of revenue per worker are growing faster than the firms within their same industry that generate lower amounts of revenue per worker. But that's just data. And what you've pointed out here is that there's really two interpretations of that. One is a kind of benign interpretation, that there's differences in the ability to produce, and in fact, or even a positive, optimistic interpretation that we're shifting resources, allocating them to the more productive firms. The other is a nefarious interpretation, is that aggregate markups in the economy or market power has gone up, and that's holding back down productivity growth, exactly because firms are generating rents and exploiting market power. And so to me, that distinction really just fundamentally epitomizes why we have to be really careful about looking at this cross-firm data and trying to take away something from that we can then use for policy purposes.
Do you reckon there's a sectoral difference in that? As we observed before, agriculture, basically a price taker. So if you're observing that difference in laggard versus frontier in agriculture, maybe more likely to be a productivity story potentially. But a lot of services sort of operate in a sort of monopolistic competition kind of world, don't they? You've got a downward sloping demand curve that you face. You've got some pricing power, not complete, but there's and you know, it's the bigger question is kind of just what market am I in almost?
Not just your product market; it's also the input market. So the example you gave, which I think great example, take a sector where we think that product market's competitive, and then there is no issue about.
Markets may not be,
but the factor markets are not, particularly in these industries where you've got farming's a great example. They're spatially very concentrated, and it's an area where they have low labor inputs, and then you get the distortion on the input margin. So ideally, if you really wanted to get difference in productivity, you need a sector which is competitive both on the output margin and the input margin. A problem is that most of the economy doesn't look like that, and then you're confounding productivity and market power. They show up together mathematically as two numbers that are multiplied together that you actually just can't tell apart in the data. So it becomes more of a political story about how you want to interpret the same data.
Interesting. Okay. So I'm going to segue from talking about firms that have been doing well to countries that have been doing well. Inevitably, the country I'm going to focus on is really just the United States, because they have genuinely been doing exceptionally well, and they're also just the country I know most about. Do you think the median US firm is more productive than an Australian counterpart, or is it just that the US average is dominated by extremely productive outliers like the Metas and the Alphabets, etc.?
It's a great question. Yeah, and I've grappled with it a bit, and I don't know why I've grappled with it as much as I can, because in principle it's kind of empirically answerable, I guess. We've looked at a little bit of data just recently that lends a bit of weight to the outlier story rather than the difference in median story. That if you abstract, and this is always dangerous, you're taking sectors out, but if you abstract from ICT so information communications technology, and I think manufacturing, because Australia, it's a low productivity growth sector for us, or low productivity level sector, that a lot of the gap disappears, it seems. And so it appears that there are a lot of sectors where productivity levels, but the implication of that would be that productivity levels, or perhaps productivity growth, it should say, from a base year, which I'd have to refresh my memory when it is, are a bit more consistent. So yeah, I'm thinking aloud. That's probably not answering the question about levels. It's answering a question about growth over time. So that would still be potentially consistent with a story about a divergence in median productivity of So the realtor in Duluth, Minnesota, compared to Wollongong or whatever, like are they more productive? I've always found that a fascinating question.
Look, I think at least in going back, revenue per worker, which is the thing that we measure, that's a very much an answerable question that something we could look at here. And I'm sure there's someone out there listening going, oh, I've done that and I've had a look at it. I don't know the answer.
If anyone's looked at that, email me. Okay, so Nick Bloom has some cross-country evidence showing that American firms are fantastically well managed, and in the international comparisons, Australia is sort of a middling country in terms of its management practices. What I want to know is just like concretely how different Australian management practices would look like if we converged on US management practices. It's not obvious to me what they do that we don't do at the moment. Any ideas?
What do you think?
Well, so the survey that you reference is one in which Nick and co-authors ask a bunch of firms in countries around the world a set of questions about their management practices. I should preface it by saying it's a relatively small survey. It's about 350 firms, so I wouldn't want any Australian firms out there thinking that this is indicative of the way they run their business. It's only about 650 firms in the US. I think we just have to keep that in mind. But if you look across what the measures are in that survey that contribute towards the average amongst those Australian firms being lower than the average for the US firms, it's the one that has the biggest difference is the set of questions about incentive structures.
Okay.
So that's a series of questions about the way in which employees are rewarded in terms of
performance bonuses, etc.
Exactly. Now, for concreteness, there are differences in all of the categories, but that one's the biggest. Is that plausible? I mean, I think it feels plausible just having spent time in both Australia and the US. But how much would that concretely change output? I don't know. That's not something that I think that this study gets into.
So then it's not obvious to me why practices like this haven't fully diffused to Australia. I mean, everyone, plenty of Australians go and work in American companies or multinationals. People talk and share information. Why don't we have these seem like simple technologies? Why don't we have these to the same extent?
I don't think there's necessarily strong evidence that's associating that change with firms performing better. That's another step that one would have to take. Okay,
I'm
a bit
what
hesitant to jump and say that.
What you're saying is maybe we don't do these things for good reason.
Maybe.
Okay.
Maybe our tax settings are not conducive to it.
Yeah.
Maybe our cultural settings amongst employees are a little different.
Yeah, that would be plausible, wouldn't it? I mean, it's hard. I shouldn't just speculate in the absence of evidence, but yes, for a lot of American managerial practices would rely on a degree of receptivity, right? And if you've got a contrary sort of workforce culture, that's going to be a problem, right? So I don't know. Maybe it's an issue. Hard to know.
So the US is nearly the only rich country to have had a positive productivity growth experience in the last 5 or so years. Do we know what it is that they're doing so well?
Well, you said it was mostly in the ICT industry. Was that?
I think that statistically, relative to Australia, for example, that ICT seems to be a big part of it. I mean, to the extent, so hence, I was going to come up with a broader.
And what do you mean by that?
Well, it's a combination of it. ICT manufacturing, but also software development.
Okay. So is this just the AI boom, essentially?
It could be part of it, along with chip manufacture, bit of Moore's law. But I don't know how much to make of the the COVID response and the immediate aftermath. I mean, one thing about the US response that was distinct was they didn't have furlough or job retention schemes on the same scale we did and Europe did to an extent. We had the JobKeeper scheme, probably a highly effective scheme for the first few months, but beyond a point kind of outlived its usefulness in terms of maintaining job matches, which really should have been at some point just liberated, right? US didn't really go down that path, did experience a faster productivity growth rebound coming out of COVID. That's casual empiricism. It's not causal. But
interesting. So for that reason, they might have had better matching.
Potential greater kind of dynamism across the economy as a consequence. But you would expect that to recede over time. I think that's really by now it would be I would have thought a bit of a stretch for us to be blaming JobKeeper for sluggishness in the labour market or poor match quality or anything.
Interesting. Okay, so one more question on the US. When I did my second interview with Ken Henry at the live event this year, he mentioned that in the 1990s, Treasury had done some work to look at what level of US TFP Australia could aspire to, and they'd reasoned that it was about 95%. The 5% gap was imposed essentially by geography. If you think about our isolation from a lot of major markets. What I want to know is, okay, so say, I don't know this for a fact, but I think it's roughly right. Say we're at about 80%, the US level of TFP at the moment. So maybe we've got like 15% to play with because we can't change our geography. How much of that 15% is culture and how much of it is stuff that like policymakers could more proximately influence?
Well, some of it's going to be sectoral mix as well.
Okay, so
maybe.
I see.
I'm not great at numbers, but some of it's going to be that our economy, we just do different things, and there's different levels of productivity.
And some sectors are more productive than others. So if an especially productive sector has a larger share of value added, then that's going to change the overall average.
Correct.
Yeah.
The cultural number, I mean, I would say it's bigger than zero. Having lived in the US, I live in the US and spent a lot of time in Australia. There are different cultures. Now, what does that translate to into these aggregate numbers? I don't know. I mean, Michael's happy to be fair game and
you can give me
throw a number, but my number's positive.
Yeah, like an over under or something.
Yeah. Well,
I mean, it needn't be positive. It could have been negative. So I'm giving you something. It's a positive number.
Yeah, and as I said before, it's a gap that's widened relative to the rest of the world. Now, query of cultural differences widened, but it doesn't have to explain all of the movement, right? I think there's something just a bit fundamentally different about the United States. I think it's just a fundamentally entrepreneurial society in a way that other developed economies approximate but don't fully achieve.
Right. Because you see where I'm going. I'm trying to do almost a process of elimination to work out, like, okay, what are all the sort of fixed,
what's left?
Fixed things. What's left? How much can we play with?
Yeah.
And to me, it feels like culture is not. I mean, you can influence culture at some margins, but it's a pretty deep and persistent thing.
Yeah, I'm less. So I agree with that to some extent, and it depends on the time horizon over which we're talking. If we're talking over the next 2 years, sure, I agree. Culture's maybe not something that we can change. But culture evolves and culture adapts, and culture responds to economic outcomes, sometimes even temporary economic outcomes. We know a lot from some of the work on this of people who've lived through hyperinflations, and 70, 80 years later, they still have very different approaches to how they invest their assets and how they perceive economic choices. So economic outcomes and the incentives that things like the tax system give us, they do affect culture. And so I don't think if the game is to raise productivity over some longer period of time, then there are policy settings that we can do that affect our collective approach to things like human capital investment, things like entrepreneurial type activity, things like how we think about incentive structures within firms as well, as we were talking about earlier.
Yeah, I think it's an interesting reflection, and again, this is not an empirical claim. I feel like I'm saying that a lot. But if you compare to just back up Greg's point, what you would think of as the canonical Australian economic cultural trope of, I don't know, 1978 compared to sort of 2003 or something like that, like over a 25-year period, I would say it changed pretty fundamentally. And the reputation that Australians had overseas, if we went to London in that era, early 2000s, the reputation of Australians very hardworking and, go-getter type young people. I don't think that was true, or certainly wasn't the kind of caricature that existed of Australia 25 years before. Do you disagree?
No, I'm too young, but I believe it.
Yeah, as I say, it's a bit of a high-level impression, but that is partly a function of policy change, and obviously culture will affect policy and vice versa. But I kind of agree with Greg. I think a sustained implementation. I mean, people probably make the same point about Britain. That there was a difference in the culture of Britain in the mid-1970s compared to what there was by the year 2000.
And let me point something out about the US as well on the same token. We talk a lot about the performance of the US in terms of productivity. The US is a big place. Yeah. And there are huge geographical variation in all economic outcomes, including productivity, including even in the same industry in very narrowly defined industries. It's very different across different parts of the US. And there's a lot of different reasons for that. There's legislation in different states. There's different cultures in different parts of the country, and different types of the level of government intervention as well, and different types of geographic barriers in the same way that Australia, not to the same extent, but in the same way. So I think that, to answer your question, that would be something that one could maybe look at to understand what these maximums are. And it's not something I've done, but I think it would be super, super interesting to better understand.
Great. So let's switch from my top-down approach of looking at what industries, firms, and countries are performing well to Greg's bottom-up approach of what are some silly policies or obstacles that we could just remove. And this doesn't need to be an exhaustive catalogue of all of those policies, but we can just talk about a couple of the more important or interesting ones. But firstly, just as a thought experiment, another thought experiment, What do you think is the smallest set of reforms we could implement to get back to that 1% to 2% labour productivity growth per year?
I think it's not that small, is the truth. My instinct is that there are probably a couple of high-profile, bigger levers, but generally I think success in this area relies on mobilising on a lot of fronts. And actually with successful periods of reform, it tends to work that way. I think once you've moved on a couple of key areas, the momentum starts to build in a few others. So I think broad-based tends to be the way to go. It's more likely to be a lot of little things than it is 2 or 3 big things. Yeah. So that's my instinct.
Sort of the nature of being a frontier economy?
I think partly, yeah. And I think when you think about what characterised the Australian economy in, say, 1983, if you date a substantial reform chapter from that point, we did have what I would describe as significant resource allocation issues because we had high protective tariffs on trade, so we had a kind of an inefficient manufacturing sector in certain industries. We had some quite big government business enterprises that were a bit bloated, that sort of thing. We had a whole bunch of areas that didn't have a lot of competition, including banking and aviation. So I think in that world there were some big things that you could do that kind of improved the efficient allocation of labour and resources. We had some obvious misallocations, and today you might make that observation, say, about the Chinese economy, right? There would be some obvious areas of excessive allocation of resources in certain sectors and that sort of thing. I think that's a harder case to make today. I mean, there are probably some sectors where we would think, we probably think we overweight investment in residential property. We've got maybe a couple of other sectors that have got some, degree of favoritism, but it's just not on the same scale. And I think for that reason, it's more likely that what we're facing is how each of those sectors innovates to get closer to the frontier is distinct from a big improvement in the efficiency of resource allocation across the economy. But that's a bit stylized. But I just that's part of the reason I think it's less likely to be the one or two or three big levers.
Yeah. So it's like government as like bottleneck detective, just going around and sort of tinkering with.
Yeah, I think there's a bit of that. Yeah.
Yeah. So we can talk about the more sensible and obvious ideas in a moment, but I'm just curious, are there any particularly unusual or ambitious ideas you've come across in your travels for lifting Australian productivity growth?
I mean, for me, the ambitious one comes back to geography.
Moving Australia up.
Not moving Australia. I think Australia's in a beautiful spot. It comes back to this bigger question of that 40% of our population is sitting around in two cities. And I think that locks up, for the reasons we've discussed, the constraints on the difficulty in being in those cities for many people and the constraints in getting to those cities. I think if we could unleash other parts of the country to be engines of productivity growth more broadly than, say, just mining, I think it's a bit of a throwing darts, but I think there's the potential returns are high. And there's a role for government in doing that because it requires a huge amount of coordination and investment in infrastructure to do it. And to me, that would be a long-term bet that I think is worth grappling with.
So this is like potentially the major new cities thing, but also just densifying existing cities like
and I'm not
Canberra.
sure if the answer is that we need more cities that are 2 million people or we need another 5 million city, or the issue is that we've got a bunch of cities with 80,000 people that really should be 500,000 people. But right now, the set of options available to a young person, ambitious, wants to contribute to productivity growth in the country for where to live, they're pretty limited and constrained by some cost factors. And so I think that now I might be wrong that it might blow a bunch of money trying to do this, but if you're asking what's ambitious and non-obvious, well, I don't know how non-obvious that is, but I think that's ambitious, and I think it's probably important if we want to have serious productivity growth over the longer run.
Yeah, it's high stakes. I mean, part of the challenge is it's the sort of thing that poorly done just results in a proliferation of grants and tax incentives and relocated government departments or whatever to small places. But yeah, I think it's an interesting feature of Australia, and it's, in fairness, this is something we're comparing ourselves a bit to the US here and not to a lot of other countries, a lot of other geographies. But yeah, where's the Phoenix? Where's the Austin, Texas? Where's the the emergent regional competitor, if you like, to the hegemony of the big CBDs? I think that's an interesting question. I mean, Greg and I were chewing the fat on this, saying, well, why isn't Canberra a city of 1 million people? I mean, you could densify that place. Barely anyone would notice. It's a great city. It offers a great lifestyle, pretty proximate to both other cities and other features. I don't know. I don't know why.
It's got high skills. Got an anchor industry already.
Yeah. But anyway,
say the federal government just decided to go all in on, okay, let's get Canberra to 1 million plus people. What are the actual policy levers? Do you settle? Is it like, do you have visas and the condition for the visa is people have to settle in Canberra for 2 years, or how do you implement that?
No, I think you've got to look at fundamentals. I think it probably is partly about land supply and the ability to densify in the ACT. I think that's a big part of it. In fairness, that is both a Commonwealth and a territory issue because there are Commonwealth agencies that have some planning responsibility there. And yeah, it could be that transport infrastructure plays a role. I'm not a high-speed rail fetishist, but maybe. So yeah, I think you asked for some of the more unusual left field things. Yeah, they're worth grappling with.
Okay. So again, we can come to the more sensible things in a moment. But I did have a question on AI. Say you were Albo and you were bullish on AI. You were fully bought in to the AI scaling laws for large language models. What would you do? What's the obvious thing to do? Is it to cover the Northern Territory and solar farms and data centers, or where does Australia's comparative advantage sit in the AI value chain?
So no, I think that's yet to emerge. I think it's yet to emerge. I mean, I don't think we yet know what are the synergies between the infrastructure piece and the, AI development and AI usage piece. Remembering in the year 2000 or around that time, we had a big debate in Australia about whether we wanted to be headlong in ICT, like chip manufacture, and there was a bit of a view that you had to be in that world in order to be an advanced economy. I think in retrospect, that was wrong, and Australia was right not to go down that path. But it's really hard to know. Do you have to be? Are there big spin-offs from being big in the infrastructure like the data centers? What is I think this is potentially an area where there's going to be a slightly fuzzy boundary between being a developer of the technology and being an adopter of the technology. So we often think of Australia as being a fast adopter of technology developed overseas, but it may be with AI that you can do that up to a point, but you need some domestic capability in order to adapt it and use it well. And I just don't think we know that yet. I think one of the questions for us is just what regulatory stance we're going to take. And I think we could do a lot worse than start with a mindset of not trying to, invent or speculate about what the harms of AI might be, not to do that kind of dystopian exercise, but just to look at our existing suite of regulatory frameworks that are really aimed at protecting against existing harms and work out how resilient they are to the use of AI, and do we need to keep them fit for purpose? I think that's a better place to start than any other, and then I think we will learn as we go.
Another random question. I was wondering this the other week, but does anyone know how important the CSIRO is to Australia's total factor productivity? Like, if the CSIRO vanished tomorrow, what does Australia's average TFP growth rate over the next decade or two look like?
Yeah, no, I think because they're two, it could be, the answer could be zero, but it could be zero partly because of materiality, or it could be zero because it's not doing the right things. I suspect it's more a materiality issue. Like, I think a lot of the work of the CSIRO, I'm not intimately close to it, but I suspect a lot of it is good work, fits where we would generally say there's potential market failure around the doing of basic research. So it's not that it's contrary or to TFP or wasteful or anything like that. It's probably just not of itself necessarily a big driver of it. But yeah, I'm sure it's had substantial benefits, in agriculture, in Wi-Fi, there are a range of things that, as a kind of an instrument or an avenue for advancing science in Australia, probably been pretty beneficial.
I'll make a plug for the importance of institutions like the CSIRO beyond what their direct impacts on productivity are. If we want to be a productive economy, we need a place for someone in this country should know how basic science works.
Okay, so I promised we would leave a little bit of space for just the more sensible or obvious ideas. Is there anything that you really want to put on the table in terms of reforms that need to happen to raise productivity growth? Stuff we haven't talked about, I guess, like tax reform is an obvious one, but I'm sort of just leaving a few minutes open if there's anything you really want to sort of register.
I mean, I can mention tax.
Yeah,
I've spoken about this before. Look, obviously, tax is not going to be the route to becoming the most productive economy in the world, but the wrong tax settings can be a barrier to doing that. And I think there are things about the tax system in Australia that are acting as a barrier. so much of future productivity growth happens within the corporate sector, particularly within large firms where there's a lot of where there's smart, talented employees working together on improving and implementing technologies. We don't have a tax setting in Australia that is conducive to encouraging smart people to want to go and work for large firms as employees. Right now, you get taxed a lot more if you work as an employee than if you run a mum and pop business that has very, very low productivity growth. Because of the way we tax capital gains, because of other incentives around the way that we tax on financial investments, and I think that the level of our labour income taxes, we think of that as just being sort of divorced from productivity, but I actually think plays a role in that.
How big is the magnitude? Like, I agree with everything you're saying, but I'm just wondering what the actual effect is potentially on productivity.
Well, the difference between making a choice to do the same work as an employee versus as the owner of a small business might be as much as 23% of your income.
Mm.
So that's substantial. That's substantial. You accumulate that that's annual. So you accumulate that over a life. It's a big chunk more money that you're paying out in tax. Now, you might be able to generate revenue, but if we think that there's externalities that come from grouping and agglomerating smart people together under the same roof, some of them have to work not everyone can be a boss. Someone has to work for someone else. So I'm not saying that this is the thing that's going to change the issues that we've discussed, but it certainly doesn't help.
Yeah, it's on the short list of just sensible, obvious things to do.
And I also think it's one of those things that we typically don't think about tax through the lens of productivity, because we don't think of human capital as being something that's something we invest in and that's affected by tax rates. And I think that that's maybe a mindset shift that needs to happen to start thinking about tax through the lens of human capital investment and productivity.
Great. Anything else?
Look, I think two of the sort of emergent issues that are not the be all and end all, but would help us along the way are the climate transition is very important, and it's important that we do it as efficiently as possible. So I think it is a shame that we walked away from what was a pretty sensible economic approach to this, which was pricing carbon emissions. And I understand the politics of it, but I think back to the goods and services tax. It went through a number of false starts. Paul Keating had option C in the mid-1980s. There was the fight back package with an electoral outcome, that sort of knocked that on the head. But within 5 years of that, it had sort of re-emerged as an idea whose time had come. It's now 12 years since the carbon price died a death, and it's still showing no signs of re-emergence. But I think it's not the be-all and end-all in the climate transition. There's a lot of other things that need to go on in energy markets, et cetera. But I do think it's an important part of making sure that we've got the most efficient forms of carbon abatement going on. And I think it should, at some point, make a comeback. The other one that's a bit more frontier, and it's hard but necessary partly because of the climate transition, is road user charging. By necessity, we've got to find some replacement for the revenue lost through the fuel excise, but it is an opportunity to actually impose a 21st century pricing model on, the fuel excise is a 20th century kind of pricing approach, right? It's crude and it's across the board. It's sort of industrial scale. We do have the ability now to charge more for the true cost of road use, which is congestion, at least in urban areas, particular routes, particular times of the day. That's got its political challenges, but that would have a pretty substantial productivity benefit in terms of the efficiency of the use of this shared asset, which is the road network. So I think we could do worse than put a bit of focus on that.
Great. This episode is sponsored by Eucalyptus, the Aussie startup providing digital healthcare clinics to help patients around the world take control of their quality of life. But this message isn't about Eucalyptus's products. You see, Australia stands at a crossroads. The world order is unravelling. We're likely entering an era of intense geopolitical instability, the likes of which we haven't seen since our grandparents' or great-grandparents' days. Meanwhile, our decades-old economic paradigm of housing and mining is running on fumes, and our culture of indefinite optimism, as instantiated in the she'll be right attitude, and our disproportionate love of gambling, has become a ball and chain. If we want to keep our prosperity and security, we need to build, to think smarter, to choose ambition and excellence. But how? We can't look passively to politics for solutions. The policymaking apparatus is straining, incapable of delivering the kind of leadership or reforms that we extracted from the system at our last major crossroads in the early 1980s. As an individual, what can you do? I maintain that more talented young Australians should be thinking about building valuable new companies. Building a startup can be one of the highest leverage ways to help both Australia and humanity, because innovation powers economic growth, and a wealthy society is a more just and more secure society, a society in control of its future. This doesn't have to mean being a founder. You can still make a large counterfactual impact by joining an early stage or well-funded startup. That's what I did as an early employee at Forage, a Sydney-born, US-based edtech startup. It was the most intense period of my life. We scaled the company, helped millions of students, and I formed lifelong bonds with colleagues. So if you're an ambitious young person wondering what to do with your career, while your decision is a deeply personal one, let this message plant a seed in your mind. Consider joining a well-funded startup like Eucalyptus or any other excellent startup. You can check out Eucalyptus's open roles at eucalyptus.health/careers. To finish with, I have some questions on the reform era and the process of reform. Given your background, these are probably more questions for you, Michael, but Greg, obviously feel free to jump in at any moment. So the first question is, and this has maybe been a big update for me in the last 12 or so months, is just realizing that the 80s reforms are potentially a bit overrated. And I wanted to get your view on this, but Australia credits the high TFP growth we had and labour productivity growth we had in the 1990s to the microeconomic reforms of the 80s. But a bunch of other frontier economies had high productivity growth in the 90s as well, and they attribute it to the computer revolution diffusing through the economy and then finally winding its way into productivity statistics. So why isn't that just the most parsimonious explanation for us as well?
It's got something in it. I mean, not every economy did experience that TFP growth in the 1990s, and so there is something to be said for Australia and US and maybe a few others, exceptionalism. So I think there is some dividend associated with the reforms of the 80s and 90s, but of course you've got to remember some of those reforms were only happening in the 90s, even in the late 90s, and national competition policy, for example. So they're almost happening too late to be a part of that explanation for the TFP surge. Does that mean they're overrated? Not necessarily. I think both in terms of the difficulty of bringing about those reforms, they were pretty substantial. It required a pretty substantial effort in terms of intellect and advocacy. But I think also it's like a consistent theme that Greg's pushed throughout this discussion, that there were reasons for doing many of these things that weren't necessarily just about TFP. The idea of bringing in competition for domestic banks, or the idea of reducing tariff barriers on imported cars and textiles and the like. These were things that were partly about expanding the range of choice and opportunities for people in Australia. And so I think in many ways that sort of reform effort, I don't think it ever had an explicit productivity motivation, not that was sort of publicly talked about a lot at the time. There was a general sense that we were falling behind in economic performance and we needed to do something about that, and we needed to be more open and energetic and, have, not shield ourselves behind protective barriers. But I think there were a lot of broad benefits associated with that.
Can I add to that?
Sure.
So I think three things. One, obviously counterfactuals are hard, but you would think on the face of it that the reforms would be more like a level effect on productivity than leading to some sort of sustained period of growth. But I also think that it's plausible to think that there's an interaction that is potentially more important. That you have, if you're going to get some big change in technology and that needs to diffuse around the economy, you need the right settings and market structure to enable that to take place. And I think you could make a case that it was the interaction of the two that contributed to it, and that the counterfactual might not have been that in the absence of those reforms, it would have been much more difficult to reap the benefits going through the 90s and early 2000s. So what do you attribute the gains to? Well, it's sort of an interaction between them.
Yeah, it's interesting. When we caught up a couple of weeks ago, Michael, I think you said that, well, your understanding of the rationale for the 80s reforms was that policymakers were thinking and speaking much more in terms of the level effects, not the growth rate. Obviously, the holy grail would be some kind of transformation to the underlying growth rate, right? If you could find policies that lift the growth rate. It's not, and this distinction between levels and rates is not a clean distinction always, but it's not obvious to me that policymakers today or in the last few decades, but let's just say today, it's not really obvious that we have levers onto the growth rate. And so it raises the question of what the role of government is, and we've spoken about this sort of like bottleneck detective role, and you've also written about like government as sort of a final guarantor or insurer. Yeah. Do you have any sort of riffs or takes on this question of, does government actually have the ability to influence the growth rate, or is the best we can hope that, every new generation, every decade or so, government has to search around for sort of the next set of reforms to raise the level, and then it's just it's an eternal process of raising the level?
Yeah, I think there are two questions embedded in it. One is, what is the role of government, or the role government can play in driving productivity improvement? The other question is, does productivity improvement happen in level terms or growth rates? I mean, I'm kind of reminded of Thomas Philippon and the work around, what looks like a growth rate is really just a series of level shifts. And that's, part of the reason why we see plateauing, because, we've seen a level shift. We've approximated the new level. We're at a steady state. And that seems to fit the data reasonably well, actually, as an approximation. And yeah, when you think about the underlying economics, most of our explanations tend to be a little bit more about levels than growth rates. I mean, the exception, I guess, are sort of education as an input, human capital knowledge as a key factor in endogenous growth models and that sort of thing. I suppose that they go more to the growth rate is something that can be influenced. But I'm kind of alive to the idea that it's very difficult for government. I mean, when I talked earlier about those resource misallocations, that's fundamentally a level story, right? That's really about you, and you can do this in a general equilibrium model, right? You can say, here's the resource allocation today. Here's the resource allocation. If we remove these various distortionary barriers, we'll get it's a better equilibrium, and it has this level effect. The things that go to growth rates, I suppose there's a question about, are we exposed to the frontier? Are we open enough to both trade and investment flows such that we're going to be quick adopters of whatever comes along? Do we have a market that really rewards success and punishes failure? Because if you do, I guess then the best ideas are going to be spread pretty quickly. That will go to growth rate in the aggregate. But I agree, it's difficult for government, I think, to have a lever that they're going to pull and say, that's going to lift growth by 0.25% or something.
Yeah, I think adoption's really important, and for adoption, you need price signals to be able to dictate to firms what to adopt and when. And there, I think governments have a role to play on both sides. Firstly, not distorting those price signals too much, And secondly, making sure that you have the right institutional environment that firms can operate and see those price signals. So again, I'm still in the bit of the world of there's more that governments can do to mess it up than to actually generate benefits that wouldn't otherwise be there.
Okay, so as an example of that sort of institutional setup, maybe something like floating the dollar did have like a growth rate effect.
Yeah, absolutely.
Yeah. So if we can look, if there are opportunities like that in the choice set, you should obviously jump at those. But once you're Australia in 2025,
some sector that's ripe for innovation that's unnecessarily regulated so that it doesn't operate like a market, even a market that's with maybe significant amounts of government oversight and intervention. Yeah, you could see that there's issues there. I mean, one of the sectors we were looking at before was the financial services sector as being a sector that had some of the fastest growth productivity growth over the last 20 years. That wouldn't have happened without the deregulation reforms, because there would have been no signals or incentives in order to innovate in that sector.
Okay, two final reflections on the reform era to finish with. So there's this worry, and I'm guilty of this too because I've spoken about this in podcast interviews, but there's this worry that Australia's economic reform era has ended. So in that period to about 2001, finishing with the introduction of a consumption tax, you could tally up maybe, 10 plus significant economic reforms. And then in the last 25 years, you could count maybe one being the NDIS. And people worry that there's been some sort of secular or structural change that makes the process of reform more difficult for a country like Australia. But what's wrong with this alternative interpretation, which I'll propose? The alternative interpretation is no, it's just the result of contingency and bad luck. If we had got the carbon pollution reduction scheme up, this was Rudd's original policy. If we'd got that up in 2009 and the Greens hadn't torpedoed it, we wouldn't be having this conversation. That in itself was a reform maybe on the same level of significance as the GST. And getting it up would have had this sort of cascading set of consequences which would make future big reforms more likely, because when the CPRS went down, Rudd balked. He didn't call the double dissolution election. That set in train his loss of leadership. It set in train Malcolm Turnbull's loss of leadership. And so you had these like policy and political consequences that have really just sort of haunted the Australian federal parliament for the last 15 or so years. So you can kind of trace it back to this one failure, which you can really understand a plausible counterfactual there, where Rudd calls a double dissolution, and none of this happens, and we're not having any of these hand-wringing conversations about the reform era ending. What's wrong with that view? I mean, that view says we just should chill out, like let mean reversion take its course, and stop worrying about things having fundamentally changed. They haven't. It's just bad luck. Is there anything wrong with that?
Look, it's got a lot going for it in a way, because I think that basic account of what happened in 2009 is about right. And I think you're right, if it had been otherwise, that would have stood the test of time pretty well. And I think Australia actually would have been a bit of a global outlier in, having it would have been a classically pragmatic Australian approach to dealing with this big challenge that has, polarised much of the globe, and unfortunately we've become a bit polarised with it now as a result. So now, we haven't seen a lot since. Would it have, all these things are path dependent, but would it have then kicked off yet further? Would this have been seen as, this is how one governs, put up a bold reform, enact it, all of that, and that means that the subsequent 16 years would have looked different, maybe. But I think it still does leave us in a where we probably can't be quite as sanguine as saying, well, therefore it'll just work its way out. I mean, I'm generally not as defeatist as many. I don't love the argument that says, we just had better political leaders or better public servants in the past I think it's also hard to ignore the fact that there are some big public policy challenges that our current crop of politicians and policymakers have faced that just weren't there to the same extent in the 80s and 90s. China, climate transition itself. These are, now what's becoming of the global trade system and the global economic order. These are really hard issues, and they're, challenging for policymakers, and in many ways, a lot of the bandwidth has been focused in those areas. So I want to cut them a little bit of slack, but I do think we need to. It's the right conversation to have about how do we sort of invest in our institutional capability and the quality of our debate so that we could reclaim a bit of that past success. What do you think, Greg?
I think there's something to your point, the broader point of these are lumpy things. They're big things.
It's history.
Drawing out trends from single lumpy things is challenging. So I'm totally with you on that. So maybe maybe tell me I'm wrong about this, but sort of with the exception of maybe the super guarantee, all of the sort of big reforms we're talking about, Australia was not a world innovator on any of them. They'd all been done and tried in other places.
Income contingent loans.
The other one I was going to say, HEX had been, it came a little, So income contingent loans, those were the two that came to mind, HEX and super guarantee. But they're not the ones, they're like the numbers 9 and 10 when people list the reforms of the 80s and 90s. So things like deregulation and floating the dollar and broad-based consumption tax, they've been tried. In 2009, emissions carbon tax, would we have been the first major economy in the
would have
world?
been among the early movers. Yeah.
It was not
with an economy-wide scheme of that nature.
Yeah, it's not like there are. It's not like there are these obvious things that we pluck from that are tried and tested that we kind of can feel pretty confident about if we just get the political will to do them. They're much more contestable, the economics of the things that are on the table at the moment. So it's a point that's been made over and over. I do think there's something to it, and I think it's true with respect to the carbon trading, carbon pricing scheme as well.
Final question. What's the most non-obvious lesson or lessons that today's policymakers should take from the reform era? So you can't say salient things like have courage or build a burning platform.
Yeah, I don't know.
I don't know.
I was very young during it, but talking to people about it, I think one of the mistakes we often make is that we think it was more coherent than it was. I actually think it was, in reality, it was in many ways pretty chaotic and a lot of following of gut instinct as much as a concerted plan that was systematically enacted. It was highly successful. I think they were the right instincts in many ways, but sometimes we impose an order on the past that wasn't really there at the time.
Yeah, that.
All right, this has been brilliant. Thank you, Michael. Thank you, Greg. Done.
Thanks,
Joe.
Joe.